Good morning, ladies and gentlemen. Capital Markets for Competitiveness and Resilience. It is my great honor to welcome you to the 11th International Financial Markets Conference. Welcome, thank you for coming. The conference is co-organized by the Ministry of Finance of the Republic of Lithuania, the Bank of Lithuania, and the Lithuanian Banking Association, in partnership with European Stability Mechanism. I think all of these organizers do deserve a round of applause as well, and maybe a stronger one than before. Thank you. This is where high-level policymakers, entrepreneurs, investors, bankers meet to discuss crucially important developments with regional and European capital markets. And I was wondering, who is a policymaker here, if you could raise your hands? They are all in the front. Anyone, an entrepreneur or an investor or a banker? Most of you, actually. Good. Is there anyone here for the first time ever in this conference? Most of you. Has anyone attended all the 11 of them? There are a couple. Congratulations. Okay, this is the last but the most important question. As the year is drawing to a close, is there anyone in the room who thinks that this will be the most important conference they will have attended this year? All of the hands should go up now. Thanks. Thank you. We were expecting that response. There are new key trends emerging, new challenges emerging. So even those who have been attending the conference for 11 years in a row will find something new to discuss and some insights to take back. This year, we will put an emphasis on the intersection of European policy, the regional dynamics of the Baltic markets, and the evolving needs of retail investors. My name is Živilė Kropaitė. I will be your moderator throughout the day. Right after the welcome speech, I will guide you through the schedule of what happens today. But before I do that, let me invite on stage Minister of Finance of the Republic of Lithuania, Mr. Kristupas Vaitiekūnas.
To see you here, all of you here. With some of you, we already met yesterday and had a really nice dinner. And because of this dinner, I'm able only to read my welcoming speech this morning. Yes. So, ladies and gentlemen, distinguished guests, it is a great privilege and honor to welcome you all to Vilnius for the 11th International Financial Markets Conference. I extend my sincere appreciation to the co-organizers of this event, the Bank of Lithuania and the Lithuanian Banking Associations. This year, we are also joined by the European Stability Mechanism as our conference partner. This partnership has already borne fruit, and an analytical paper released today that I am sure will enrich our discussions and provide valuable insights. And of course, I would like to thank all of the speakers from around the world who have kindly agreed to join us today and share their experience and expertise. Over the years, this conference has become one of the most important financial gatherings in the Baltic region, a place where policymakers, market leaders, and innovators from across Europe meet to exchange their ideas and chart the way forward. The theme of this year's conference, Capital Markets for Competitiveness and Resilience, reflects the realities we face today. In these challenging times, Europe must strengthen its long-term competitiveness, accelerate innovation and digital transformation, reinforce defense capabilities, and advance the bureaucratic simplification agenda. Capital markets are central to this effort. They are not just a source of funding, they are a strategic instrument for building a more secure, innovative, and sustainable Europe. In our government program, we have set a clear objective to deepen and modernize our capital market, to broaden its instruments, and to integrate fully into the EU Capital Markets Union. We recognize that capital markets are not only an additional source of financing, they are a systemic instrument for economic growth, recovery, and resilience. They are becoming increasingly vital and mobilizing funds to achieve our national objectives, from defense financing to digital transformation and global competitiveness. Let me go quickly through today's themes and the panels. The first panel will focus on Europe's Savings and Investment Union and the opportunities it presents for deepening financial integration. The European Commission's Saving and Investments Union initiative reminds us that unlocking private capital requires a diverse, resilient, and inclusive financial ecosystem. This panel will explore how capital flows can be better aligned with Europe's strategic priorities, how we can facilitate access to the financial instruments and overcome market fragmentation. At the European level, Lithuania fully supports the Saving and Investment Union initiative. It aims to channel Europe's vast savings into productive investment, particularly into small and medium-sized enterprises, the backbone of our economies. By doing so, this initiative will help strengthen competitiveness, deepen financial integration, and improve access to capital across the European Union. The second panel will focus on regional efforts. The Pan-Baltic Capital Market Initiative, developed jointly by Lithuania, Estonia, and Latvia, is a powerful example of how regional cooperation can overcome scale limitations and attract broader investment. Strong regional capital markets are not only drivers for economic resilience, they are also essential building blocks for the European Savings and Investment Union. Our cooperation in the Baltic region clearly shows that joint efforts can achieve. Together with our neighbors, Latvia and Estonia, we are building integrated, efficient, and attractive Baltic capital market. This collaboration has already delivered tangible results. Harmonized covered bond frameworks, the Baltic Capital Market Accelerator Fund, and unified offering requirement for issuers. But there is still more work to be done to deepen liquidity, broaden investor participation, and enhance the international visibility of our markets. In light of today's geopolitical challenges, we must also rethink how we finance defense infrastructure and industrial resilience. We will discuss that in the third panel. Mobilizing both public and private capital through blended finance models and innovative EU-level instruments will be essential to meeting Europe's evolving strategic needs. The global financial landscape is being reshaped by profound geopolitical shifts. Russia's ongoing war against West in Ukraine has tested not only our security and unity, but also the strength of our economies and markets. In these circumstances, the role of capital markets becomes even more crucial to provide stability, mobilize investment for reconstruction, and sustain the foundations for democratic prosperity. We must help Ukraine rebuild stronger through capital, innovation, and integration into the European and global economic and political systems. Finally, in the fourth panel, we will examine the future of retail investment in Europe. Some may argue that Europe's markets remain fragmented and overly cautious. The key question is, how do we unlock Europe's untapped potential without compromising our high standards of investors' protection and market integrity? At the national level, Lithuania continues to strengthen its financial ecosystem. We are simplifying the taxation for individual investors through the investment account, fostering financial literacy through the National Financial Literacy Plan, ensuring that citizens can make informed investment decisions, encouraging public participation in national priorities. A great example is the successful issuance of defense bonds, which enabled citizens to support Lithuanian security while earning a return, showing how financial instruments can build both resilience and solidarity. Expanding opportunities for SMEs to list on the stock exchange, opening new paths to growth and investment. We are also proud that the State Investment Capital Company became the first issuer under NASDAQ new European defense bonds model. a step that illustrates Lithuania's leadership in aligning finance with security goals. Finally, the Capital Markets Council plays a crucial role in bringing together the public and private sectors. It ensures that reforms respond to the real needs of market participants, helping us identify challenges, remove barriers, and sustain momentum for growth. Ladies and gentlemen, capital markets are not an abstract concept. They represent trust, cooperation, and a shared belief in the future. By strengthening them, we are investing not only in financial instruments, but in the long-term security and prosperity of our people and our democracies. Let us continue to work together across Baltic region and across Europe to build capital markets that are strong, resilient, and ready to meet the challenges of our time. Thank you, and I wish you a productive and inspiring day.
Thank you, Minister, for an inspiration and also for providing us with a quite detailed outline of what happens during each panel. So what I will do, I will just say that the structure will be as follows. We will have 4 panel discussions with top-notch speakers and moderators. And before each panel, we will also have a keynote presentation linked with that panel. And in between, there will be 1 lunch break and 1 coffee break, I think. And if we do respect the allocated time slot, we will be done by 3:20, and then we will have a networking session here just behind the door. So good luck to us. Thank you very much. And it is my pleasure to present the first keynote speaker, European Commissioner for Financial Services and Savings and Investments Union, Maria Luis Albuquerque is with us. Welcome and thank you for coming.
Good morning, distinguished guests. I want to start by thanking the Lithuanian Ministry of Finance, the Minister, Kristupas, the Bank of Lithuania, and the Lithuanian Banking Association for hosting us at this important event, the best conference of the year. I am truly delighted to be here in Vilnius, in a part of Europe that so powerfully embodies our shared European values. Together with your Baltic neighbors, you have shown remarkable solidarity and moral clarity throughout these challenging times. As the EU's frontline states, you carry a heavier burden than most. Russia's war of aggression has deeply impacted your citizens and your outlook. Yet you continue to respond with strength, resilience, and compassion, especially towards the many Ukrainian citizens you have welcomed. Your example is an inspiration for all Europe. Your resolve is a reminder that security does not rest on military power alone. It also depends on economic strength, the capacity to innovate, to invest, and to act decisively when the world changes. Russia's aggression goes on, and its ambitions remain clear. This makes our need for strategic investment in security, innovation, and resilience more urgent than ever. Throughout my remarks, I want to address the imperative of strengthening Europe's financing ecosystem. I will highlight the example of the Baltic region, where integration and collaboration have delivered tangible results, and explain how we are advancing this same spirit across the European Union. Capital markets support innovation and spur economic competitiveness, reinforcing Europe's resilience and our collective capacity to project influence in the world. The single market demonstrates how integration amplifies our influence. A larger, more integrated economy gives Europe real weight in setting global rules and standards, in trade negotiations backed by 450 million consumers, and even as a non-military instrument through our sanctions policy. We have to force Russia away from the battlefield and to the negotiating table. and that requires cutting off the financial means that sustain its war. Our 19th sanctions package further tightens the economic vice on Russia's war machine. This is the strongest sanctions package yet, directly targeting Russia's core revenue streams and war infrastructure. It imposes a total ban on Russian LNG and significantly broadens the clampdown on Moscow's shadow fleet, which now totals 557 vessels. This package also targets financial services, including the first ever crypto restrictions, as well as services and trade, while strengthening anti-circumvention tools to close loopholes. Europe's lasting strength depends on the vigor of our economy and the pace of our innovation. These are the foundations of geopolitical influence, and they must be at the heart of our common agenda. This is the course we are charting. The Commission's competitiveness compass will guide our efforts to reignite growth and unlock the full potential of our greatest asset, the single market. Building on this vision, the Savings and Investments Union strategy, which I presented earlier this year, sets out a clear roadmap to channel savings into productive investment, to strengthen our capital markets, and to secure long-term competitiveness. The start of this political cycle has made one thing clear. No economy in Europe, and indeed none in the world, is immune to the consequences of growing geopolitical and economic volatility. This volatility is no longer the exception. It has become the backdrop of our time. And this is not a storm that will pass. It is a structural shift demanding a structural response. Europe must raise its competitiveness and productivity to transform uncertainty into renewed growth and confidence. To do so, we must summon political resolve from across the Union to modernize our economic model, strengthen our investment capacity, and ensure Europe stands as a true peer among the world's leading economies. This vision will resonate strongly here in the Baltic region, where the value of integration has long been understood. In partnership with the European Bank for Reconstruction and Development, you were among the first to see how harmonized capital markets could unlock growth, as was just mentioned. An ambition formalized in the 2017 Memorandum of Understanding to deepen regional cooperation and overcome the constraints of scale. In doing so, you created a single, more attractive pan-Baltic asset class. The same logic now guides our work at the European level through the Savings and Investments Union, our effort to turn Europe's vast pool of private savings into a true engine for investment, innovation, and resilience across all member states. You have achieved the consolidation of infrastructure through the merger of the central securities depositories of all three stages into one single Nasdaq CSD, which demonstrates the highest degree of regional integration in EU markets. This is a remarkable achievement and shows the rest of Europe what can be achieved through vision and cooperation. We aim to replicate this success at the EU level via our market integration package, which we will propose by the end of the year and will focus on removing barriers and facilitating consolidation of market infrastructure across Europe. The Baltics have raised their profile internationally through the creation of the MSCI Baltic Index, boosting the competitiveness of the region. The venture capital and private equity scene in this part of Europe is dynamic, innovation-driven, and highly active. And that is not by accident or coincidence, it is by design. The success story of the Baltic financing ecosystem is a powerful testament to the value of shared purpose. Your success results from a collective strategic vision. And I was encouraged to see that you continue to be ambitious in this project through your joint letter to the EBRD seeking new impetus to your existing cooperation. Your motivation in 2017, the drive to dismantle barriers, achieve scale, and create barrier-free capital markets, is the very same crucial motivation we champion today at the EU level. The development of deep and liquid capital markets at the EU level requires this same spirit of collective action. Your collaborative efforts will experience a multiplier effect if they are undertaken in support of the broader EU-level measures. Our collective horizon always extends further than any individual one, a message that I take into every meeting I have with member states. As policymakers, our role is not to create demand or dictate where private investors should allocate their capital. That is and should remain the job of the market. What we can do is make it easier for those investments to happen by removing barriers, improving regulatory clarity, and creating an environment where good ideas can find the funding they deserve. Europe does not lack innovation or ambition. We have brilliant entrepreneurs, also here in the Baltics, where a remarkable number of unicorns have emerged, proving that talent and creativity are not in short supply. What we need is to better connect those innovators with the right investors. Building stronger and more integrated capital markets across Europe will help companies grow beyond national borders, attract long-term investment, and scale sustainably. The Savings and Investment Union is designed to bring more liquidity into our markets, strengthening the entire investment ecosystem and unlocking Europe's growth potential. Under the strategy, we are working to assertively remove fragmentation, simplify regulatory burdens, and bring further harmonization that makes investing across Europe more straightforward. In practice, this means more opportunities for citizens to manage their money and avoid financial stress, be it through financial literacy programs or through purpose-driven savings and investments accounts, which incentivize citizens to invest in the economy and to directly benefit from its growth. Essentially, through the Savings and Investments Union, we are working to put in place the systems that enable success in Europe, allowing markets to decide on their own terms where resources are best allocated. This includes strategic areas such as defense, artificial intelligence, semiconductors, and the broader green and digital transitions. Our task, therefore, is to set citizens and businesses up for success, and then have the confidence to step back and let them thrive. One avenue to pursue is through our pension system, which is, by definition, a powerful and consistent long-term investor into our economy. Robust pension systems are essential to the long-term social and economic well-being of our societies. As populations age and demographic pressures intensify, the importance of ensuring reliable income security in retirement continues to grow. Pension systems are first and foremost about providing adequate retirement income so that citizens can move into this phase of life with dignity and stability. However, pension funds also play a foundation role in financing our economies. Across the world, we see a clear pattern. Countries with well-developed supplementary pensions also have deeper capital markets, which in turn translate into more equity financing for companies. In a few days, we will adopt a package on supplementary pensions. Our goal is simple: help people build more secure and diversified retirement incomes while providing more financing to the economy. To achieve this, we will make it easier for citizens to understand and track their pension savings, and we will encourage wider participation in pension schemes through auto-enrollment. When we mobilize the long-term savings of Europeans, everyone wins: pensioners, businesses, and the economy. I would like to mention that the SIU is not a strategy to benefit the largest member states. In a truly integrated market, no member state is peripheral. Every market, large or small, is part of Europe's growth engine. Smaller markets, as the bigger ones, will be vital entry points into the wider European ecosystem. The goal is ensuring that all markets are fully connected to the broader system. And that is where the real opportunity lies. For local businesses, this means direct access to a much bigger playing field and pool of capital while staying local. In this process, everyone gains from a more efficient, more attractive European market for capital. Yes, the transition may bring some costs, and some players may find that business models built on small scale or limited competition are no longer viable. But the benefits will follow. And once they do, they reinforce one another, compounding over time and making each next step easier and more rewarding. As Commissioner for Financial Services, I am spending a great deal of my time visiting member states to explain the vision behind the SIU project and to build support for it across Europe. Creating a truly European financial ecosystem would be a transformative step, comparable in scale and impact to the establishment of the single market itself, with all the benefits it has brought to citizens and businesses alike. But to reach that goal, we need genuine political commitment. Too often, long-standing national preferences and protectionist reflexes continue to hold back our collective progress. The success of the Baltic countries shows what can be achieved when markets are open and scale is embraced. It provides a powerful example that I often highlight in my discussions across Europe. Proof that integration, ambition, and openness can translate directly into economic success. In closing, and before moving on to our panel discussion, I would like to leave you with a simple reminder. In Europe, our greatest progress has always come when we move forward together. The single market, once our ambition, is now our foundation. I encourage you, all of you in the room today, to reflect upon the benefits that a unified and truly European market for capital could bring to your work, your businesses, and your daily lives. Keep the Savings and Investments Union on your agenda, and let's continue working together to drive momentum. I will continue to move forward with optimism and with a vision of a stronger, more self-reliant Europe. And I trust I can count on your support to make this vision a reality. Thank you.
Thank you, Commissioner. I would advise that you pick one of the comfortable chairs, and we will invite more speakers. Thank you for emphasizing the need of strategic investment in security and long-term competitiveness, and actually putting an emphasis on the success of the Baltic financing ecosystem, and telling us what Europe is doing to achieve the goals. I will also invite on stage Minister of Finance of the Republic of Lithuania, Kristupas Vaitiekūnas, to join the panel. You can give all of the speakers a warm hand so they feel more comfortable coming. Director of the European Department at International Monetary Fund, Alfred Kammer. Yes, please. President and CEO of Swedbank, Jens Henriksson, is with us as well. We are also very happy to invite on stage a partner at Ripplewood, chairman of the board at Citadele Bankers, Tim Collins. And the panel will be moderated by senior fellow at Bruegel, Nicolas Veron. Welcome, and have a fruitful discussion.
Thank you very much. We have an all-star panel this morning, so I won't spend much time in introduction. I will just first thank the Commissioner for a very inspiring speech, and maybe ask each of the panelists to kick us off with a few introductory remarks on what you respectively expect and from the Savings and Investments Union. I mean, there is a little bit of cynicism in Brussels, I have to say, on a project which has been rebranded several times and has been reborn several times, but where the track record illustrates the difficulty of moving forward. So I don't share that cynicism, as you know, Commissioner. I think there is great opportunity right now to move your agenda forward and in a big way, but this remains to be demonstrated. So let me ask first you, Minister, and then the other panelists to just give us your initial reflections on what is really at stake and what can be realistically achieved. Thank you.
Okay, thank you. And thank you, Mary Lou, for kicking off this conference with a presentation on SIU. It was very interesting. And of course, we all know what we're meeting here on the times of uncertainty. And on that uncertainty also gives us some opportunities and opportunities to shift our thinking from regulation, from safety, and shift it to resilience and innovation. Of course, it's easier said than done, and as always. But these times and these circumstances, I think, works in our favor to do this mental shift not only in thinking but in the culture surrounding ourselves and the culture of business, culture of financial markets, of finance, and I really look forward to discuss this shift and implementation of Saving and Investment Union with all of you on this panel. Thank you very much.
Alfred, the IMF has been there before. I remember a previous cycle of comprehensive reform at the time of the Eurozone crisis, culminating in 2012 with the decision to initiate a European banking union in the Eurozone. The IMF was a very important participant in that debate and also a force to propose new solutions. What is the IMF seeing and suggesting now?
Yeah, let me go a bit further and provide context and link to the Commissioner's big themes of productivity and resilience. When you are looking at Europe, you will find right now that the per capita income of Europe is a third less than in the United States. And if you are looking at why that is, you will find out that 70% of this gap is explained by lower productivity, a bit explained by labor, a bit explained by the capital stock, but the bulk of the gap is explained by lower productivity. And when we are looking forward, that productivity gap is to widen. And this is a situation Europe cannot afford. Europe has dismal growth projections in the medium term, and Europe wants to maintain a social welfare state, and that means Europe needs more growth. Europe needs to generate the revenue in order to support that welfare state. So reforms and closing this productivity gap is a must. And that's where the Capital Markets Union is coming in. When we did a study on going to the firm level of where does the productivity gap come from, the message was very clear. When you're looking at European firms, they don't have the chance of creating economies of scale by working in a large integrated market. Too many intra-European trade barriers are still existing. And Draghi and Letta focus on eliminating those, because otherwise companies cannot grow and the real investment opportunities are not going to be created. Second point, which became obvious, and that connects now to the Savings and Investment Union, is that the ecosystem for companies who actually are innovative and who actually can grow doesn't exist because when you're looking at a startup needs high-risk investors. A startup needs venture capital. And venture capital is much less available in Europe than it is in the US. And when you're looking at an innovative firm, and when you're looking at economies of scale, then you need to look at scale up. And for that, you need deep capital markets and you need equity, because all of that is risky. And the bank-centered system of Europe cannot produce that capital. And that is another reason why we don't see young, innovative companies in emerging. And especially in this economy, where the growth really is coming from the technology side, from information technology, communication, etc. Because these companies have as a collateral intangibles. And that's not where banks can come into the lending part. And that is why we need a savings and investment union in order to generate that eco-environment for these dynamic enterprises to succeed and grow.
Jens, well, I have to disclose that Jens Henriksen and I go back a long way. That's for due disclosure. Jens, Alfred just told us that banks cannot help startups. What's your response?
Yes, we can. Well, first, let me just say thank you for the invitation. And let me just say a few words on Swedbank. We have 4 home markets: Sweden, Estonia, Latvia, and Lithuania. And we believe in group-wide policies and frameworks, but we believe in national decision-making. And we have a strong CEO, sits over there, Inga Skisacker. She has a fully fledged subsidiary bank, and she is the decision-maker in Vilnius.
When you mean national decision-making, you mean inside the bank, not for policies that create the capital markets union in the government? Or?
Correct, but she takes the decisions on lending and things like that. So you have any complaints, go to her. Also important to say that we are the market leader in Lithuania, both on the corporate side and on the retail side. And we're also the most loved brand in the Baltics 7 years in a row. And we have an eternal perspective on being the bank in Lithuania, because we believe in Lithuania. We believe in the long-term growth of Lithuania, and you can just see what happened the last few years when Lithuania has excelled and delivered stellar growth. I have 5 messages, and the first one message is to Madam Commissioner, and that is that regulate for growth, not only for risk. So that's the first point. As Alfred said here, clearly, we are lagging behind. We need to do better. Second, as also worked at the IMF before, I love regulation, but 90,000 pages, Madam Commissioner. Use ChatGPT and tell it, please take it down to 10,000 or maybe 5,000. I don't know, but try to do something about it, because it's too easy to make mistakes, and you should make it easier to do the right thing. The third thing is, as Madam Commissioner said in her speech, is to create a stronger investment culture. And in order to do that, we need also not only the Commission, but we need to see the ministers, the sort of local, the national decision-making. We cannot leave this to the Commission alone. These are small, everyday decisions taken by the ministers in Latvia, in Lithuania, in Estonia, and Sweden, and all other countries. Then I get to the fourth one, and that's sort of, we need sustainable and profitable bank. Therefore, I'm very happy, Mr. Minister, that you've decided to let this Lithuanian bank tax have now for a few years expire. I'm looking at the Latvian colleague and I say, look at Lithuania, that will be good for Lithuania, and I would sort of recommend you to do something similar in Latvia. The fifth point then is that, you see, well, hope we get the same applause in Latvia. We need a strong pension system. And then sort of, if you look at the pension reform you, Mr. Minister, are doing right now, there are a lot of caveats in it and some dangers. Please make sure that you handle this pension reform in the right way. Thank you.
I knew you were a rock star in Vilnius, Jens, but now
Well, it's half my people employed here.
it's confirmed. Well, now let me turn to a global rock star of financial transformation, Tim Collins. I think it's not an exaggeration to say you have been a force, and your fund has been a force for transformation of the financial industry in countries around the world, not just in Europe. So can you give us your perspective of the way you look at the European banking and financial market right now and its potential for, doing more for the European economy?
It works. Okay. Well, first of all, we're going to have to go back to the bank and find out, because they told me our net promoter scores were higher here than yours. So we've got a statistical problem in our data analysis. So we'll have to sort that out. Anyway, it's a pleasure to be here. We also are big believers in the Baltics and in Lithuania. And as you know, we have invested over and over and over again since we made this investment in the original bank, and tripled our assets in the region because we believe in it. I would say that my first reaction is that having also a incredibly complex experience with the capital markets in France and in Holland and in Luxembourg, and trying to move around that jurisdiction, hats off. I mean, I've spent more money on lawyers than I think we've spent on developing the business at some time. So it's much needed, and I think will be a very, very welcome welcome change, not just for foreign investors and international investors, but just ease of doing business by the enterprises that are trying to migrate the European market. Second, I would say it is absolutely unequivocal, having invested in the U.S. and Japan and Egypt, that cost of capital, access to capital, is a national source of competitive advantage. I mean, Japan squandered it, but Japan was built on low-cost access to capital. It was from banks, not from the capital markets, although the stock market had its bubble, but the real driver were the banks, who were also big owners of stocks. And that's what built Japan. Japan, innovation and engineering and all that, but they had huge access to capital, and that's what built the Japanese economy, that then obviously had its own issues that we participated in. But the U.S. today is what it is because it's the reserve currency and because of the depth and breadth of the capital markets, and that allowed that more than venture capital. Venture capitalists rely on IPOs. There is no venture capital business unless there's an IPO. So what really drove, I think, the amazing productivity boom and technology innovation in the U.S. were three things. One, Harold Brown, Jimmy Carter's Secretary of Defense, made it a priority to take defense and intelligence technology and ship it out to Silicon Valley, and that's what gave the kickstart to the ecosystem that became an ecosystem. The IPO market, which is up and down and up and down, but that's the lifeblood of the venture capital, and just the size of the market. I mean, if you win in America, it's a big enough market that you ought to be able to scale. I would, however, having also invested in lots of small markets, say don't leave the small markets behind. When you homogenize everything, you need to be aware that capital will migrate to the biggest, most liquid names, and with the exception of these hot IPOs, a lot of smaller companies could get left behind in the process and pay a price, and that is something you need to really think through with this market. And so my advice to the region is get your act together before, and create national champions, create reference securities, create an environment where you're going to have investable businesses that will survive the consolidation of a European market, and that will serve you very, very well. Get out ahead of the curve. But I'd also say to those designing this thing, don't forget to leave these small markets behind. They need to be developed before they're integrated, or they have a chance to get lost in the shuffle. So anyway, I'm very optimistic about the region. I think, you know, we've invested in big businesses and small businesses, and we're investing in a relatively small business in France now, and the ability to move and innovate and be disruptive is there, and that's the world, that's the economy we're in. You get paid for innovating and disrupting in the current environment, and the technology tools to do that are the greatest in my lifetime. And so a smaller market, we were talking earlier, dominate a small market and then scale to the world. And these markets are perfectly, perfect analogs. If you win here, just like they say, if you can make it in New York, you can make it anywhere. If you can make it here with these innovations, they're scalable and they're exportable. And that should be a very, very, very important part of the economic plan for the region. Anyway, thank you very much.
Thank you. I'm curious about the French story, but I'll leave it aside for this panel because that's not our job.
I'm going to take the Fifth Amendment on that story.
Indeed, and it's not our geographical focus today. So, Alfred, I'd like to come back to you, picking up on something Tim just said. The defense, rearmament story, or in the US case, armament story, during the Cold War has been the trigger for the innovation engine of Silicon Valley. Is there the same kind of opportunity now for Europe? How do you look at the pluses and minuses of the new defense effort in terms of economic efficiency and productivity? There's a lot of debate about multipliers, but as Tim reminded us, it's not just about the Excel spreadsheet. How do you look at that at the IMF?
I think 2 points. So a lot has been said about the possible productivity advantage of expanding the defense sector, getting the innovation going, and looking at the American model. I think one needs to be a bit careful there because it depends on what kind of military hardware is being produced, how much is actually being innovated in Europe, how much is actually imported from outside of Europe. And you mentioned the fiscal multipliers depend very much on that, but also the potential growth aspect. A second point, I think, which we are trying to make is when you are doing a scaling up of European public good and European and national defense is one of, and the defense security is one of those. Don't forget to do it at the European level and use the European budget. And we have suggested to actually double the spending in the European budget on these European public goods, because you're not only getting the coordination advantages, but you're also getting savings across Europe, which are very important. And there are estimates that on the defense side, if you just move to common procurement, you save 30% of the cost. If you are moving together on the energy side, you are saving 7% of the energy transition. So focus on the European level because it creates efficiency, coordination gains, and savings.
Commissioner Jens Henriksson mentioned the regulation in terms of taking into account the risk, but also the growth potential. There's a lot of debate on this. So before we get to capital markets stuff, which we will get to, I'd like to have a bit of your thinking about banking, because there are a lot of debates in Europe right now, and specifically the combination of banking regulatory simplification, a number of voices calling for decreasing capital requirements, a number of people looking at what's happening in the US in terms of deregulation, or I learned that word recently, de-supervision. Where should Europe go? How do you look at what's happening in the US in terms of both competition and risk? What's the way you look at that landscape?
Thank you, Nicola. Well, as part of the Savings and Investments Union, we will also get to the banking sector. So we are starting to prepare a very thorough competitiveness report on the banking sector because we want to ground our decisions on evidence. We will need that evidence on what exactly may be the issues hurting the competitiveness of our banking sector. And we will get to that. And I don't know, I will not preempt the conclusions of such report or such evidence, But I think that we need to look at not just the banking sector, but our economy. And I'd like to take the point about the growth and risk. I do believe we need to find a better balance between both things. In the aftermath of the great financial crisis, as we know very well, the main concern was we need to manage better risk, we need to mitigate risk, and there was almost a drive to try and eliminate risk. But if you eliminate risk, well, it's not even possible, but if you try to eliminate risk, you end up eliminating the opportunities as well. So I think we need to find a better balance. And that is something that we will clearly need to discuss now when we're talking about digital assets, about crypto, about stable coins. Where should we focus most? On the risk or the opportunity that it brings? And I'm really hopeful we can find a right balance. As for the regulation and the too many pages, yes, it has become very complex. We should strive to make it simpler, but I would like to remind everyone that it's not just about what is written or the number of pages. It's very much about supervisory practices, and it's not just at the European level. Everyone needs to contribute, because to what starts to be something relatively complex, we see national authorities adding layers of complexity. And that is also not helpful. So this is just to remind that it has to be a collective effort. For us to succeed in this area, as in others, is as much top-down as bottom-up. And we would eliminate as many pages as possible, but bear in mind that even with such detailed and prescriptive regulation, national interpretations manage to put things all over the place. So imagine if we were being quite light and principles-based only. I have no idea if we would even have something that resembles a banking union, as in a way we already have. Incomplete, but still there.
So, if I hear you correctly, there is legislative work that is being wrapped up on crisis management and deposit insurance. There is an expectation that this will be enacted in the next few months. And then the next big step for banking reform will be this report coming next year that will include the simplification stuff, putting it into context and competitiveness, also completion of the banking union. Is that on the table?
Oh, that's part of my mission letter, absolutely.
Okay, very good.
I was there in the beginning, it's still incomplete, so I'm back to see if this time I can do it.
That's encouraging. When is the report going to be published?
Next year.
At what time next year?
I'd say probably after summer.
Okay.
But there's no defined date yet.
Lots of hope there. Minister, I'd like to shift to capital markets. One thing I realized at the dinner table yesterday, I can make that disclosure, is that the Baltic countries, together with a number of other European member states, are labeled by most index providers as frontier markets. And to me, as a European, it's kind of, in a way, counterintuitive that member states of the EU would be frontier markets, but that's what it is. If the capital markets union, savings and investment union agenda is to be taken seriously, I guess once the job is done, we would have European equities, including Baltic equities, as a single asset class, and viewed as such as by market participants, such as the index providers. What would it take to get there? What is the number one reform, or maybe top three reforms that would get us to that single market nirvana?
Thank you for the question, but first of all, I would like to react a little bit and complement a little bit to the things Tim said about how Silicon Valley was founded and kickstarted from the defense industry, from the technology of military. I want to say that something similar is actually happening in Lithuania at the moment, because even before the war started in Ukraine, we had these high-tech companies in Lithuania that we've been focused in laser industry and optical industry and other high-tech industries with the products known all around the world and exported to all the countries. And now when the war started, we were living the 4th year in the war. and we increased spending for defense significantly. So majority of this money, of course, goes to purchasing the weapons from tanks and anti-aircraft guns and so on. But one way or another, some funds find its way to these smaller companies for innovation. And the good example is now that we had this a hybrid attack from Belarus with smuggling meteor balloons flying all over the Lithuania and all over our airports. And immediately the government reacted. They started a little fund on the Ministry of Economy to provide these small companies who manufacture or have some plans to develop anti-drone, anti-aircraft weapons, and these funds go to these companies. So something a lot smaller scale than Silicon Valley, but something similar is happening here. And of course, capital markets and saving and investment union is a crucial tool for accelerating this trend, because the public spending it's not sufficient for that. We need better access to capital markets. And to answer your question, what would be the main driver to upscale the market, to make it more trustworthy, more deeper? There is no one factor, I think. Of course, as was mentioned, the market participants must be ready to take risks. The risks provide the possibility for gains, but in this situation we have we are willing to take financial risk, but we need to mitigate and lower the risk from geopolitical surrounding of Lithuania. So this is ensuring security in the country probably is one of the key moments. Another moment is probably attracting, easing the burden of bureaucratic burden of participating in the market, of issuing bonds, and of course our cooperation with other Baltic states, with Latvia and Estonia, it must accelerate. We now have this common bonds mechanism that allows for better borrowing, but it's just a start and it needs to accelerate quickly.
Tim, do you think the EU equities could ever become a single asset class? How do you look at it from your perch?
A single asset class? I don't even know what that means. You mean that a Baltic, a Lithuanian company will trade as it's European as opposed to the fact that it's Lithuanian?
I was taking the example of the equity indices. So if you think of MSCI or other index providers, they segment equities into different levels, frontier, emerging, developed markets, which signals structural differences from a country to country basis. So that's a start.
I really am not that familiar with how the MSCI works or what their cutoffs are. So I don't know. But when investors look, they're going to look at the business and the market and the environment for the market, as well as the breadth of the capital markets and the liquidity in the system and so forth. But I think ultimately, the lens is going to be focused clearly on the enterprise and its prospects, and this index stuff I don't really understand. So I'm the wrong person to ask about that.
So let me rephrase the question, because we have the commissioner here on the panel. Is there anything you expect from EU-level policymakers to improve the environment for investors investing in the kind of stuff you invest in?
Well, look, I would say, we had this experience recently trying to move from a Dutch-listed company to a French company, and we had to stop on the way in Luxembourg, and it was a very complex exercise. And I think eliminating things like that would be really helpful. It would be bad for lawyers and good for businesses. So any things like that that make it simpler to list, make it more homogeneous, make the regulation more transparent and more homogeneous is a good thing. My only hesitation is that you create this great big homogeneous market. That's a really good thing for the market in general, in aggregate, and a really good thing for Europe, but you don't want to leave the smaller markets behind, so they need to have a special lens, a special focus in order to make sure that they're not left behind, and some measures to help them in the transition.
Just to understand, and of course you can take a pass if you want, but in the case you're referring with, was the difficulty coming from differences in national legislative frameworks, or was it more national supervisors creating obstacles out of their supervisory discretion?
No, it was different frameworks. It was just different, commercial codes and corporate requirements, and it was just complicated. And all I'm saying is that that's a good thing. Getting rid of that's a good thing. Making it simpler so that if you invest in any jurisdiction or you list in any jurisdiction, the rules are the same. That's a really good thing. Taking friction out of the markets is a really good thing. Adding breadth and liquidity is a really good thing. Just don't leave the small markets behind.
Alfred?
Yeah, just to add on the don't leave small markets behind. I want to be more aggressive on this one. Open up all markets so that firms can operate across the EU and not just in their small market, and then we harmonize. And second point I want to make is when it comes to regulation. Now, we have been asking many countries to eliminate red tape, simplify regulations, all of that. But another important point to make is EU regulation is actually fantastic because it's regulation across 27 countries instead of 27 regulatory regimes. The problem has been that national authorities like to gold plate. And that means we are getting 27 regulatory regimes. We have the same problem on the supervisory side, where we have ESMA, who could provide pan-European supervision. But ESMA, to some extent, has been forced to harmonize supervisory regime across the 27. And I think there we need to see Europe as one playing field for enterprises, Europe as one regulatory regime in order to give freedom for companies to use the whole market, not just the small market.
Jens?
Well, could I take the other perspective? I mean, not ask so much what you can do for us, but what we can do back. And I think the key point is that going back to the customer and make them first to increase financial literacy. So if you go over here to the Swedbank offices, we spend a lot of time of educating people. We travel around the country talking about how important it is to have a budget, to be sure that you invest. We've created something called micro-invest. So every time you buy something, you round it off and end up buying equities, talking about the advantages of taking part of this as well. And I think that's one way forward, coming from beneath, not just asking on top. Because one of the biggest problems with this savings investment union is that in many countries, people, well, I'm not allowed to say that probably, save at banks. They shouldn't. They should buy funds. They should have a higher equity exposure in their occupational pension, in their local pension system, in the national pension system. Create indexes and funds like that and go out to the consumer. That is what it's all about.
Commissioner, the issue of supervision has already come up, and that was probably inevitable. That's one of the big pieces, of course, of the debate on savings and investment union in the capital markets area, so without having to wait for the big banking report of after the summer next year. Well, the good news is this is an area where the European Union has a legal and, in a way, political means to act. The organization of supervision in the EU is decided by qualified majorities. There is precedent of supervisory integration in other areas. Of course, micro-prudential supervision of banks being the most obvious example here in the Eurozone with the single supervisory mechanism, but also more recently for anti-money laundering supervision with the creation of AMLA, the European AML authority, which is starting in Frankfurt. So, long-winded introduction to my question. How far can you go? How far will you go? We heard about ESMA. Verena Ross is in the room. Can ESMA be upgraded into a European SEC, as Christine Lagarde memorably called for it? What's your plan?
Our plan will actually be put on the table before year end, so it's being finalized as we speak. But let me tell you that what we envisage is not an SEC-like supervisor, because we don't think that is the best way forward. We want to get to single supervision, which is not necessarily the same as single supervisor. And the point is, we have it very clear. If we need single rule books, and we need, if you have a single rule book, you ask a question, the same question, you should get the same answer wherever you ask it. We're not close to that. So we need to get to single supervision. But the EU is way more diverse than the US. So I am pragmatic. I know what we want to achieve, single supervision, and we will look for the best way to deliver that. In some cases, for example, entities who are mainly acting cross-border, yes, they should have a single supervisor. Why should they have to report to 17, 20, 27 different supervisors? They should have only one. So depending on the type of activity, on the nature of the activity, whether it's mainly cross-border, we should think of a single supervisor. But in many cases, many of the participants, because capital markets are very diverse, banking is way more homogeneous than capital markets. We may find it better to keep supervision more local, but exactly applying the same rules and with the additional necessary tools to make sure that supervision is actually convergent. So yes, that will mean that ESMA will have not only increasing power, more power, but it will also have to have a different governance so that it can deliver on the expectation. So the point is single supervision. That will mean for some parts of the market, single supervisor, in others, still local supervisors, but with convergence tools, with proper enforcement, with additional power so that we can guarantee the outcome. And also, this is the proposal that the Commission will put on the table, but as everyone knows, but too often forget, the Commission can only propose. Then we need to count on Council and the European Parliament to actually draft the final text and what it is going to look like. So if we want this to work properly, we need everyone to be engaged. This is really something that only works, as I said before, if we all push in the same direction. So single rules, single supervision, clearly. Obviously, don't leave the small markets behind. Actually, that is one of the things I mentioned, and that seems to be this concern that whatever we do is for the big markets. Well, first, there is no such thing as a big market in Europe. We're all small. Some of us are more aware than others, but we are all small. And actually, I think that this, what we call the smaller markets, or more peripheral, have more to gain, because they will be given access to a much bigger pool of resources, will have much higher visibility. And actually, if you integrate, that integration benefits everyone. Those who are smaller or less visible for investors are the ones who have more to gain. But yes, this has to be a joint effort for everyone to get to that particular integration. So, and I'm not sure exactly what is help in the transition, because whatever we will be deciding, we'll decide together, smaller, bigger inside the EU, and this really has to be a joint effort. And just to use words that were used by Colin, yes, also here we need to be innovative and disruptive. The size of the challenge will not be met if we try to just make small adjustments at the margins. We really, really need to be very different, be bold, and take some risks in the political angle on how we manage this joint project.
So many of us in the Brussels bubble, of course, view this issue of supervision and how to reorganize capital market supervision as really the centerpiece of where, you know, your agenda will succeed or fail in this area of capital markets. So let me keep you on the spot for one or two more minutes, if you allow me, Commissioner, with two brief follow-up questions, and you can make brief cartoonish responses. That's fair. So one is, you know, supervisory convergence has been essentially the motto for a generation. It was started with the Lamfalussy report, the creation of the Committee of European Securities Regulators in 2001, almost 25 years ago. Essentially, it has failed. It hasn't delivered. Nobody is satisfied with this. Some senior supervisors or former supervisors have said it in those simple words. Supervisory convergence has failed. How could it succeed in the future if it has failed so comprehensively for 25 years?
I do agree, we have a problem of credibility. That is clear. I mean, we are starting to look like the boy who cries wolf. We keep been announcing the same thing again and again, and we haven't really delivered much. The point is there any better alternative out there? Because honestly, I don't see any. There seem to be some entities convinced that they can protect what they feel is, I don't know, the national space, where there would be some specificities that justify the differences. I think that what we have is fear of change, and for many, it's very human. If you push powers to the center, whoever is holding it now will lose it. And losing power is something that people don't like. It's human nature, it's absolutely natural. What we need to understand is that whatever model seems to be working relatively well now is not fit for the future. Because the size of the challenges we're facing, the level of competition is not comparable to the past. When we built the single market, all our rules, including state aid rules, competition rules, were designed to guarantee a level playing field inside Europe. We were competing with one another. That's not the name of the game anymore. Our competitors are not, the competitors of the Baltics are not Germany or France anymore. We're talking about competing with the US and China. This is the level of competition that matters. And for that size, none of us alone is big enough.
So how does that make supervisory convergence succeed in the next round?
Because it gives, I think, now the political momentum of understanding that we either succeed together or fail if we stay apart. We are talking about Europe and the rest of the world. It's no longer some of us. So some of these reflexes from the past that do the thinking and the policy making strictly within national borders are no longer going to work. And I think the understanding has improved. And there is no better alternative, honestly.
My second question is about this idea of that, you know, smaller firms would be supervised at the local level, larger firms or more cross-border firms by ESMA. And in a way, that's what we have in banking supervision, right? We have this divide between less significant institutions and significant institutions, and I know that it serves as an inspiration for the way you're thinking about it. But let me just ask a question about the incentives. So we're talking about these disruptors, these startup businesses, also in the area of capital markets. If I'm an incumbent, I'm supervised by ESMA. If I'm a newcomer, I'm supervised by the national supervisors. That means if I want to enter another country market inside the EU, I have to build another and then yet another and then yet another supervisory relationship before I enter the big league. Doesn't that create a barrier to entry?
Maybe I didn't explain properly. It's not, the division is not merely by size. It's also the type of entity. One of the proposals we'll be putting forward is that supervision under MiCA is centralized. And our proposal is that it is for everyone, because we're talking about a very innovative sector that evolves way faster than our regulation can ever expect to follow, especially given our timelines. So we don't see a particularly good reason to build 27 competence centers on something that is so specific, innovative, and challenging. So it's not, the divide is not necessarily by size. It is what works best. And I would say that, for example, digital, bigger or small, by design is cross-border.
Isn't everything digital now?
No, not everything, not yet.
Okay.
But hopefully it will be.
on that hopeful note, I want to open it to the floor. We still have 10 minutes left, and I very much look forward.
Nicola, could I just...
Jens, yes,
could I-
please.
So we worked together before at the IMF, and I have a question to you. And that question is that...
Okay, I'll release my moderating role here.
So sorry about that. But we all know that the worst thing that could happen is that something explodes. Well, we all can do good things, but we know that if the financial market there is a problem, that creates problems for a long time afterwards. I have the privilege to work very close with Latvia when the global financial crisis happened. Now you're sitting here with the financial elite of Lithuania and Latvia and Estonia. Give us some advice. What do you see? What should we look out for? When you see the region, what are you scared about? Tell us what to look for and sort of help us.
That's a big ask.
Well, you're from the IMF.
But we are humble. We are recognizing also our limitations. I think as part of this discussion of deregulation and what we need to do in order to strike the balance of dealing with growth and risks, we should be careful in going forward. One of the biggest achievements, I think, after the global financial crisis is that we have a safe and sound banking system, which is well regulated, is well supervised, and is resilient. And I remember when we had the crisis with Silicon Valley Bank, American investors and banks in the US were not concerned about the US. They were absolutely sure that the Fed would intervene quickly, the Treasury would intervene quickly. This would not create a problem for the US. They were looking immediately at Europe and were expecting what are the spillovers and what are the ripple effects, and is there a big issue arising from Europe. Yes, Credit Suisse happened. But Credit Suisse, to some extent, was not a surprise. But in the rest of the banking system, nothing happened. And that, I think, is one of the great achievements after the global financial crisis. And when we are talking about the balance of growth and risks, not to forget that we are in this situation because of the huge effort which regulators and supervisors and banks did after the crisis. What to watch? One thing is non-bank financial intermediaries. Whenever you have a regulated sector, risk moves into the unregulated sector, and you need to be wary of the connections between hedge funds, private credit, private equity, and the banking system. Because in the end, if something happens there, it's going to spill over and is creating then the possibility of a financial crisis. And you made the point, Jens, you want to, at all costs, avoid financial crisis because they're hugely expensive. And I think we should not forget that this should, in the end, be the guiding principle.
Thanks, and thanks, Jens, for this question, but I do want to give also the opportunity to people in the room to ask questions. Now, there are very powerful headlines, so I don't see necessarily everybody who may be raising their hands. At this point, I don't see any hands raised, but help me. Yes, we have a question here. Please, if somebody can bring a microphone.
Hello, my name is Gintarė. I'm from the Bank of Lithuania, Lietuvos Bankas. And I would like to ask, when we're talking about removing some regulation, so let's imagine miracle happens. So do you have anything specific in mind? What regulation has to be removed that this market becomes very nice, very competitive and expands? Thank you.
Thank you. Let's see if we have other questions from the room. I'm mindful of time, so we may not have time for many rounds of questions, but this is your moment. Not sure I see very well. If not, let's turn to the panel for the question.
Could I answer that?
Absolutely.
What the key point is, as I said, is that I like
Please
regulation.
speak in the microphone.
Okay, so I like regulation. I'm very much in the corner of Alfred here. I mean, I've seen the consequences, and one of the things I learned then was we talked in the IMF about banking will never be the same. And banking is not the same. It has its pros and cons. And if you look on credit losses, for instance, in our bank, we're down to like 6-7 basis points. That's good in one way, but of course, you need another capital market in order to get equity into the small companies, because banks are not willing to take that risk as much as before. That's important to say. So we need regulation, but you have 97,000 pages. And I do not know how many people have just trying to understand the rules. Please keep the rules, but make it 10,000 pages. Use ChatGPT. So I don't have to spend so much time and seeing sort of, on the one hand, I'm going to have a personal account dealing, making sure everybody needs to have an account. On the other hand, I need to make sure that that we do not have money laundering and things like that. They are conflicts. Please go through it. Make it easier. We want to do the right thing.
Minister, what do you expect from Brussels in terms of regulatory reform?
Well, of course, to answer this question, I can give you an example. We worked on some simplification of some rules, and these rules were concerning the fintech companies in Lithuania. And the feeling just to simplify these rules is like you know, when you drive a car, you have 6 gears to go front to upwards, and to simplify these rules, you felt like going all that distance, you went in 6th gear, now go in reverse gear. It was very difficult because it's not about regulation. It's about changing our mind from security, from living nicely to taking risks, improving competitiveness, and getting your hands dirty, doing the real job, not reading these 90,000 pages of regulation. We need to change our mindset to change that. Not one single regulation will change the situation.
Tim, if you had a magic wand, is there one thing you would recommend at the EU level?
No, I don't have a magic wand. I think that's a question for somebody's PhD thesis, not for my glib comments on a panel. But what I have one magic wand, and I think this is counter to the feeling of the room. I think lack of regulation of crypto is a gigantic risk to the system. We spent a fair amount of time looking at making an investment in a bank that handled crypto, so we did a lot of work. I have yet to find a legitimate use case for stablecoin, for Bitcoin. So I think the idea that lots and lots of transaction and payments should be on an opaque distributed ledger with blockchain is a really dangerous proposition, and I think that I've spent a lot of time trying to understand it, and I definitely don't understand it, so I'm still waiting for someone to explain to me the legitimate use case other than hiding and speculating.
Thank you so much for that, and I was starting to feel bad that we hadn't addressed crypto and stablecoins in this panel, because that's a buzzword of the moment, and especially thanks for doing so with such candor and honesty. Commissioner?
Just one brief comment, because your last comment, Tim, gave me the idea. Maybe I was misunderstood, so I want to make very clear my comment. Crypto is regulated in Europe. MiCA was a groundbreaking regulation, which was actually considered a very good regulation for once. I think it was quite unanimous. So I was not preaching for lack of regulation. I was just saying that the ongoing discussion on whether MiCA is enough or not, is a good opportunity for us to have a proper discussion on the right balance between risks and opportunities. So that, because this is a sensitive topic, and I just wanted to make sure that it was what I said was clear.
Tim?
I wasn't implying anything different. What I was basically reacting to is the enormous pressure from my country to the world that if you don't get on the train, it's going to roll you over, which I don't believe. And also this discussion about a digital euro, I think is a mistake. You may not like Visa or MasterCard, but there are plenty of other solutions to this issue, and I think they will come from the private sector. They should come from the private sector, and but it's not. I have yet to hear anyone explain to me how a digital euro that's hosted on these thousands of servers around the world and they're protected by blockchain technology, how that's a good thing for the system. So or for frankly the reserves in the banking system, much less control of money laundering and other such activities.
So, as this exchange illustrates, there's 1,000 topics that we haven't done in this panel, but I think we have covered already a lot of ground. I want to give very warm thanks to all 5 panelists, and the other topics will be addressed in the rest of the day. So now it's time for the next steps. Thank you so much to everybody for your attention.
Thank you very much, everybody, for this intense and wonderful panel. And I'm happy to announce that the next step is actually a coffee break. It's not extensively long, so do not forget to come back here at 10:50. So roughly 15 minutes for a coffee and a little bit of chit-chat, and then we continue. Thank you. Welcome back, those who are back. Does anyone think that the coffee break was too short? Those who are back probably don't, but there are many people who think it's very hard to drag them back. But I hope that once they've heard the music and me speaking, they will eventually understand that there is something important finally going on stage. And we want to be on time because we want to have a longish lunch break, right? And then continue with the rest of the topics. As promised, we will be speaking about developing Baltic Capital Markets Hub in this second panel discussion. Before that, we will have a keynote speech, and I'm trying to be slow so that people can gather and sit down and relax and listen. So after the panel, we will have a lunch break. And the sooner we start, the sooner we end, and the longer lunch break is. So, developing Baltic Capital Markets Hub, but before that, a presentation. ECM has been referred to many times during the first bit of the conference, and the panel debate as well. So we can finally invite the chief economist of the European Stability Mechanism, Rolf Strauch, with us. Let's give him a big round of applause and invite him on stage.
Good morning, ladies and gentlemen. It is a great pleasure for me to be here in Vilnius, and I sincerely thank the Lithuanian Ministry of Finance, the Central Bank, and the Banking Association for the excellent work in preparing this conference. The European Stability Mechanism was honored to join the preparation of this event as a partner and to contribute to the theme of capital market integration in the Baltics. Achieving deeper integration is an important goal, and as we also heard before, it's a sincere reflection of the common European project to move towards a savings and investment union. Let me coin the vision of my contribution here by saying it is the move from a Baltic capital markets hub towards a true regional capital market union. Why is ESM looking into this? The ESM mandate is to safeguard financial stability of the euro area and its member states. And there is a very clear link between the level of integration of capital markets and economic and financial resilience. Having well-integrated capital markets increases private sector risk sharing. This translates into better shock absorption through investment and credit flows across borders, which help distribute losses and profits among countries. This can smooth economic cycles and enhance resilience. As a result, financial stability can be supported without necessarily drawing on public money. Well-integrated capital markets also support economic growth by improving efficient resource and asset allocation, attracting foreign investment and supporting innovation and productivity. Sustained economic growth, in turn, reinforces financial stability by strengthening the capacity of the economies to absorb shocks and a robust financial system. This does not mean that a European public backstop, and this is essentially the role of the European Stability Mechanism as a crisis resolution mechanism, would be obsolete. It's not. However, it should reduce the need for governments to step in and the risk that we may have to support the country. Against that backdrop, it is clear why ESM attributes high importance to the Savings and Investment Union project. We look at it from the perspective of a crisis resolution mechanism and as a market participant. We operate globally in financial markets as a seller of Eurobonds and as an investor. The ESM holds 80 billion of paid-in capital to back our high creditworthiness, and that we have to invest securely and profitably. We were happy to accept the invitation of the Lithuanian government to provide a policy note on the Baltic Capital Market Hub. The question to ask and to answer is why it would make sense for Lithuania and its Baltic neighbors to maintain and strengthen regional cooperation in parallel to the Savings and Investment Union. Or in other words, what are the benefits of deeper Baltic capital market integration in an environment where the Savings and Investment Union will be rolled out over the coming years? Our assessment in addressing this question departs from the analytical work we have done on the Savings and Investment Union itself. We fundamentally agree with the European Commission and with European policymakers that it is important to bring capital markets to households and firms in order to make this Savings and Investment Union a success. In an analytical study entitled Capital Market Union Redux Towards a Deeper and More Equitable Savings and Investment Union, published as an ESM discussion paper in May, we explore how a truly integrated market could be achieved. For that, we use comparative practices to identify the best practices among EU member states. One of the authors, my colleague, Matthias Gustowski, who is also here in the audience, has worked on that paper and built on the insights from the paper and applied it to the Baltic region. I thank Matthias sincerely for his work. There he is. For his work, which is now also published, and you saw it before, on the ESM website under the title Capital Markets in the Baltic Region, a Deep Dive. My speech builds on his analysis, and I will explain where we see the scope for improving the working of a Baltic regional capital market and converting savings into productive investment. And I will finish my reflections with a set of concrete policy considerations to achieve that integration and deepening. We have heard before about the history of the Pan-Baltic Capital Market Initiative since 2017 and the achievements that it has brought from the Commissioner. So I won't repeat that, but just reconfirm, in many respects is a role model, and there are concrete achievements, such as a harmonized covered bond regime, the launch of the Baltic MSCI index, and a joint Nasdaq listing as concrete measures that were taken. But we think, and that I said at the start, the initiative can go further in converting savings into productive investment. Looking at the profile of household savings in the Baltic countries, we find that households in these countries overall save less and have less wealth than the EU average. This is displayed in the chart on the left for savings and in the chart on the right for wealth. That should not come much as a surprise, also because incomes are lower in the Baltic countries compared to the EU average, and the fact that the region went through a deep crisis and adjustment period that involved an internal devaluation around the time of the global financial crisis. It led actually to a period of negative savings on aggregate, as households dissaved in order to compensate for wage cuts. Nonetheless, the savings allocation of households is broadly comparable to that of the euro area average. But here there are interesting cross-country differences. Estonian households notably hold a significant lower proportion of their savings in cash and deposits, as we can see here, while other countries are more in line with the EU average. One explanation of this variation is financial literacy. Households in Latvia and Lithuania display levels of financial literacy broadly in line with the EU average. While, if you look at Estonia, Estonian households score higher than the EU average. This variation on financial literacy suggests to us that more can be done in order to convert savings into productive investments in the Baltic countries in the future. At the same time, and that is very important, and you see it on the right-hand side, Baltic households appear to place notably less trust in investment advice than the EU average. And this is clearly a deterrent to household capital market engagement. We believe it may also be related to people's experience with their funded pension system and the advice they received for investing for their old age. To address the issue, a possible step forward would be to strengthen the supervision of those entities providing investment advice and also possibly harmonizing it across the Baltic countries. The Baltic countries made early progress in expanding funded pension schemes. As a result, Latvia and Estonia have a ratio of retirement savings to GDP that is higher than in France or Spain, for example, and in the case of Lithuania, still higher than Germany and Austria. However, pension funds in the Baltics have contributed less to the development of local stock markets than in these countries, as you can see on the right-hand side, where the Baltics are on the very low end. More visibly, obviously, in those charts, and very clearly, the Baltic countries fall way behind both the level of retirement savings and stock market capitalization achieved in neighboring Scandinavian countries and in the Netherlands. Why is it that the Baltic countries rank very low in market capitalization despite having assets earmarked for retirement? There are two answers to this question in my mind. First, the pension funds allocate a very low share of their investment to domestic firms. You see on the right-hand side that the allocation to assets overseas is higher in the Baltic countries than anywhere else. Baltic stock markets are seen, and that was mentioned before, even by local funds as risky, given their limited scale and liquidity, and also their classification as frontier markets by FTSE Russell's and MSCI, two global equity index providers. The ranking as frontier markets deters both local and foreign investors. And the cautious behavior may actually create a deadlock. The limited involvement of institutional investors constrains the growth and liquidity of local stock markets, and in turn, this prevents them from reaching the scale that is needed for more capital and improved market conditions. We believe, and that is the core of the message I want to leave here, that there is more room for pension funds to increase their allocation to Baltic firms without compromising the interest of pension beneficiaries. A second issue are the operational costs and fees charged by pension funds. In Baltic countries, they remain high by international standards, although they have already come down over recent years. But the fact that they still remain relatively high suggests that there is insufficient competition in the fund selection process. What can we do? We can learn from examples of best practices among EU member states how to address these two issues. A notable feature of Scandinavian pension funds is their active contribution to regional investment and firm creation. This is due to a substantial share of assets in startups and growth stage companies. Crucially, the investment mandate of these pension funds allow investments in unlisted equity and infrastructure projects. When successful, they generate significant value for pension beneficiaries and for the economy overall because they foster business formation, job creation, and productivity gains. Another critical success factor is the high cost efficiency achieved by Scandinavian pension funds. They maintain some of the lowest operating costs and fee levels in Europe, thanks largely to a competitive selection process. This process involves regular tenders where participating funds compete against a low-cost primary pension fund established within each scheme explicitly to serve as a price leader, which puts downward pressure on costs and fees. Such model ensures both strong investment performance and cost discipline, which together contribute to the success of the system. I would like to conclude now by outlining some concrete policy recommendations. An important incentive to strengthen the Baltic Capital Market Initiative is to gain the necessary scale to become more attractive to investors. This requires pooling investors and directing savings into joint investment fund structures. In our view, changes to the way the funded pension system operates is a cornerstone to address these challenges. Several concrete policy measures can be taken to strengthen the funded pension system. Based on the example I just mentioned, national authorities in the Baltic countries could consider reforming the Pillar 2 pension system by establishing a primary pension fund that acts as a default choice and price leader within the scheme. These structures could help drive down costs and fees for pension beneficiaries. The primary pension fund should also be granted an investment mandate that allows for significant allocation to unlisted equity, including companies in the startup and growth phases, thereby fostering capital market development within the region. We also see merit in harmonizing the tax treatment of national investment savings accounts to enable greater scale and facilitate cross-border investments. Finally, centralizing the supervision of Baltic financial markets under a common authority would promote greater harmonization of regulatory and supervisory practices, a topic that was also discussed before at the European level, but maybe there are different options here. Initial priorities could include coordinating initiatives to improve financial literacy, education across the region, and strengthen the harmonized supervision of entities providing investment advice to enhance investors' trust and confidence, a point that I mentioned earlier, because it is an important deterrent for capital market participation. These measures would contribute to shaping a more integrated, deeper capital market in the Baltic region, which would support the creation of the necessary scale to finance long-term growth and significantly improve people's well-being. It would also affect people's choice in keeping money in the system. Other regions face a similar challenge, and a parallel regional initiative has been launched by Central Eastern European countries. In such regional initiatives, the expectation is that regional proximity and alignment will allow to go further in the integration of capital markets than in the case of the Savings and Investment Union, which fundamentally relies on national coordination and alignment among countries. Or as the Commissioner has put it before, the hope is that you can be role models on where to go with the Savings and Investment Union. Strengthening this regional integration, in our view, is not a nice to have, but a must, in order to generate the quantum leap for Lithuania and its Baltic neighbors to make progress. Thank you very much.
Thank you very much for the very specific recommendations. I would advise you to take one of the chairs and please be seated. And there will be, I think, 6 in total panelists. I will invite them all one by one, and if you could continue giving them a hand as they go up here, this will make them feel more welcome, I hope. Chair of the Board, Bank of Lithuania, Gediminas Šimkus. Minister of Finance of the Republic of Latvia, Arvils Ašarādens. Head of Baltic Exchanges at NASDAQ, Karel Ots. Managing Director for Central and Southeastern Europe, EBRD, Charlotte Roue. And expert, former European Court of Auditors member, former Minister of Finance of the Republic of Lithuania, Mr. Rimantas Šadžius. And this particular high-level panel will be moderated by Associate Senior Research Fellow at the Financial Markets and Institutions Unit at the Center for European Policy Studies, Dr. Judith Arnal. Welcome, and the floor is yours.
Okay, good morning. It's a pleasure to be here today. We have an all-star panel and 6 panelists. I think that this is the most challenging panel I'll ever moderate in my life because we have 6 panelists and very, very relevant ones. So I'll skip the introductions. You all know who they are. The idea is to try to stick to the time, so I'm going to be very strict. And we'll try to have 2 rounds of discussion, and then then maybe a golden minute. Let's see if we achieve that. So the first round is basically to discuss the state of play. The second round is to have a more forward-looking view. So I'm sorry for my pronunciation. I'm Spanish. So I would like to start with Minister Asseradens. I'm sorry for my terrible pronunciation. I'm aware that a memorandum of understanding was signed between the three ministers of finance in 2017, also with the support by the EBRD and the European Commission. That was almost 10 years ago. So what's your assessment of this MOU? What achievements do you think would be remarkable, and what things are still pending?
Thank you for the question, but I might say all speakers so far had described the situation, and it is very, very interesting. It is from one point is perfect, and from other it's quite a drama here. And let's put it like this: if we speak about market infrastructure, capital market infrastructure, it's really excellent, and already I'm thankful for those who said it is a good example for European markets. We really running a single Baltic capital market. We already have a, let's say, same infrastructure, common. It really works as a common exchange, and everybody who is placing the IPOs or selling bonds on market, that's works in all three countries. And if we speak about ecosystem, we have let's say local institutional investors, we have private investors, and so on and so on. Excellent thing is we work hardly with MSCI and on let's say on development of Baltic Index, and even MSCI just find for Baltics new classification now. It's we now call it not only frontier, but we call it advanced frontier market, and of course what is good about it's I might say mostly the legislation is harmonized around three countries, and I would like to thank a previous reporter about potential advices what to do. For example, let's say, which is a very interesting idea to have a single regulatory authority. In somehow, I might say we don't have it legally, but the harmonization legislation is done on the level where we could say it is similar in all three countries. That could be an easy step to do, and this is actually is very good advice. And of course, if we look and further steps. We have a lot of common activities, like government-created fund, IPO fund, which is created in order to help middle-sized entities to make important steps to create an IPOs, and this of course is great. And of course, what we do is right now we're negotiating with Euroclear in order to create a chain of access to the European Central Depository in order to have, let's say, information and transitional flows to let's say, European institutional, let's say, investors. That's all we have. But same, come to the drum part, is if we speak on debt market, that's flourishing. Really, it is. It's showing two digital growth numbers, and companies are very active there. But if we speaking on equity market, we could wish more. And this is really a big how to say, it's fundamental issue. And as a previous report from European Stabilization Mechanism, it was excellent. It's mentioned what we have. How to say, fundamental challenge for all governments. We have a hell of a lot sleeping capital in our countries. Not a problem to having, let's say, international investors or whatever. We have a lot of capital. It's accumulated in pension funds. It's accumulated in private accounts. In Latvia, we have in private person accounts, we're already having close to 12 billion euros, which not moving. Yeah? And the company accounts, the same thing. Yeah? There's a hell of a lot of capital without working. And how to make, how to create investment culture, yeah? How to create an investment culture, that's fundamental issues for our governments. Sorry.
No, thank you so much. So a lot of sleeping capital, but we have very good policy recommendations by the ESM. By the way, congratulations to Matthias for a very good report. Governor Šimkus, what's your view? What achievements would you point into, and what pending issues do you think are still there?
Thank you. As for the pending issues, probably we'll cover this in the next question, but on the state of play as I see now, I want to stress the importance of the capital markets for the countries as Baltic states, because in normal times, it's all right to have banking finance, but innovative companies, startups, growth companies, they are financed through the capital market, which is typically takes more risk, and a balanced system that diversifies risks, both in good times and worse times, is a must. In the Baltics, we have experienced, I would say, evolution of the capital market, and we were severely hit in 2008. And while the banking industry has recovered since then, we've started seeing, let's say, more prominent signs of a recovery of the capital market, I would say, only in the last 4 or 5 years. And rebuilding, and here I would use rebuilding the Baltic capital market, is it's somehow like rebuilding a house. You could have good plan, good drawings, but until you don't see cranes, nothing is happening. So in 2022, Bank of Lithuania issued capital market development plan. It turned into the government-approved capital market development guidelines. But the other very important thing was the establishment of the Capital Market Council, where industry, where Bank of Lithuania representatives, Ministry of Finance, Ministry of Economics and Innovation meet, and they discuss. And they have visions, they have strategic direction, and they have measurable KPIs. And then the question is, so do we see results? And I'm really proud to say that in some areas, absolutely yes. And the issuance, debt issuance by the corporates in the primary market, so it achieved, the numbers are for 2024, more than 700 million. Crowdfunding platforms raised almost 300 million euros a year. So it's quite substantial given that we started almost from scratch. Having said this, of course, there are room for improvement, and stock market development is something where we should pay more attention, as it was very nicely shown in your chat, where we are, like Baltic states are lagging behind in terms of the stock market capitalization measured by GDP. The same applies to the turnover ratio. So this is something where things needs to be done. Very good ideas about the bigger role of the pension funds, but it would also stress the importance of the local retail investors. To some extent, we are proud. We measured that the local investors number increased to almost 200,000. But where they invest is basically outside the country. The capital market is not a goal by itself. It's a means to finance the economy. Lithuanian economy, Baltic states economy, Euro area economy, European Union economy. So therefore, in my next intervention, I would address this topic too.
But I already see some very strong and common messages emerging. So good developments on the side of debt, not so good on the side of equity. The relevance not only of institutional investors, pension funds, but also of retail investors. So Mr. Ots, I mean, all the efforts to integrate trading and post-trading infrastructure, what kind of tangible results have they delivered for investors, for issuers? Was this only nice to have, or has this really delivered positive results?
No, of course it has. I think Governor is spot on with his building a house analogy. We have been building a house, maybe slower, but some things require time. I mean, you don't want to rush also with a house building. The key metrics of measuring the health of a capital market in any region is what we saw on the slides, is the value of stock exchange listed instruments to GDP. Well, jokingly, if we had a lower GDP, it would be higher, but nobody wants that. So if we now line all the countries together, EU average is in the middle, and our countries, we lag behind roughly 4 times from the EU average. EU average itself trails the US by a similar margin. I think we all now know this, knew it also before, but I think it's also important to look at the reasons. We, in the Baltic region, have had 34 years to develop not only the market economy, but capital markets, capital pools, the infrastructure, everything. Just for context, the Swedish exchange, a good example in Europe, is a 170-year anniversary, just recently. So one thing is that we need time. The other is focus. So what can we do? I think we have done well in terms of financial literacy, but it's a never-ending job. Investor relations of the companies better than ever before. Equity, I agree, slow but steady. The fixed income market, there was a good stats in Verdogenius very recently that the amount of interest income earned by investor has more than doubled in recent years. So very good result. And also the regional cooperation that has been already mentioned by many speakers today. And I'd just like to highlight the importance of the MSCI. So what that we are from 2023 part of MSCI Baltic Index? Who cares? So I tell you what, we worked for over 5 years advocating, meeting to get it done. MSCI indexes are followed or benchmarked by over 85% of all global investment funds. That's why. It is the first in Europe, and I finish soon. It is the first time in Europe that such a regional index has been created. So it is a big deal. Also, what the minister mentioned, the advanced frontier market. Besides our 3 countries, it's Romania and Slovenia. And MSCI specifically says that the market access is at the level of a developed region, not even emerging, but developed region. Just it's a matter of size. So whether we like it or not, size matters. And size, organically speaking, needs time, but we all know, or at least some of us, what are the criteria of us moving from frontier region to the emerging. This criteria is now a little bit closer. It's still challenging. We need 3 companies worth more than 2 billion. There is a free float and liquidity requirement, but it's closer. It's more doable. And again, to why? The difference between the passive capital inflows between frontier and emerging are 200-fold. So there is a major liquidity issue to be taken advantage of. So I will stop here.
Thank you so much. Ms. Rohe, as a representative of the EBRD, you have been very closely involved in supporting the 2017 MOU, but at the same time you have an external view. So what are the main bottlenecks you have identified? What's your view?
Well, good morning, sorry. And I'm really happy to be here. Thank you so much for the invitation, looking at our National Bank Governor. And for EBRD, this has been a really important work. I'm looking at my former colleague, Andrej Kuzvek, who was involved at the start when he led our capital markets department. So it's the first place where we've had this kind of cross-border work. And the completion of the covered bonds initiative, I think, is really a landmark. So we supported this effort. You know, the way EBRD approaches the capital market development is the advisory side, providing support on legislation and regulation, and then we invest. And being able to cover all three makes a difference, because then when it's time for an institution to come to market, we're there to buy the product. So with the covered bonds, we worked together with the three governments on the frameworks to issue, backed up by collateral, which could be used across the three countries simultaneously. And then Luminor Bank had a covered bond program between 2020 and 2022, and we supported those issuances. Following Luminor, other banks came to the market, we were able to support them. So I use this example because I think it's a model of what we can do with others. But overall, the work of the three governments has been important in showing the way for others. So we have started working in Central and Southeastern Europe with 8 governments, actually starting with the stock exchanges, on integrating their back offices and trading. And the Minister of Finance of Croatia came forward and said, well, we actually need an MOU among the governments, which is what we had here in 2017. So I think that there's a lot more to be done. I wouldn't be hung up on the label of frontier. As Carol explained, it's about size, and it will be about liquidity. And there is more that can be done, bringing companies to the market for debt and equity, but I'll save that for the second round of discussion. Thank you.
Thank you so much. Minister Satius, you've been a minister not once, not twice, but 3 times. So I think that you have a very good overview of what's been happening at EU and national level. What is your take about the combination between reforms at national level, cross-national cooperation, and EU integration of those cross-national cooperation efforts?
Judith, thank you for introducing me as 3 times minister. I was also once a member of the European Court of Auditors. A very bad one from the Commission side, because I was that bad guy who conducted the audit of the Capital Markets Union project. It was 2020. 2015, it was action plan announced by the Commission of building the Capital Markets Union in Europe that had to be done very fast. And when we scrutinized the ongoing reforms, first we drew the map, which is still there, and I will just immediately after introducing this report mention it. And overall success. And we found that the story is very long. We found the first communication of the Commission on Capital Markets Union coming from 1996. So the problem much older. I can remind you that the action plan that we are now working on, according to which we are working now, the European institutions and the member states, comes from 2020, another action plan. So multiple action plans, and there was overall conclusion of the Court of Auditors. Well, we were bold to audit this project, but we also were bold in our conclusion. At that time, in 2020, it was a failure. It was a failure. And the first and foremost problem was mismanaged expectations. Expectations were too high. So we all were prepared to do very big things in a very short time. But now this map, when we look, say, at the map in terms of the depth of the capital markets, it recalls the map that Rolf showed us just in the slide on MSCI indexes classification of the countries. We have Western Europe that has, all countries have quite well-developed markets, capital markets. And we have Eastern Europe, where in some countries, I wouldn't say this about the Baltic countries, but in some countries it is almost practically non-existent so far. So there are big problems, first of all, with the development of national capital markets. It was one of our conclusions. Another conclusion was that, okay, we are globalists. We are trying to build a very big building, capital markets union in Europe at once. Maybe we could start from putting these bricks together in some areas. And here, a very good example that we quoted was 3 Baltic member states, 3 Baltic states. You will be surprised to hear that the European Commission disapproved this approach. They did not agree to implement this recommendation of the court, starting work with regions of similar countries. And I think that time has proven, time has gone, 5 years, time has proven that the court was right. The court was right, and previous contributions showed that, well, we have achieved quite a lot. Now, talking about Capital Markets Union project as such, there are very many players, and there could be very many perspectives from which you can see the problem. And maybe one of the errors at that time was stemming from the very name of the Capital Markets Union. Can you imagine any political party going to the election and writing on their flags capital markets? Well, union is okay, union is fine, but capital and markets is absolutely no go. I think it was extremely clever after Enrico Letta's report to rename this into Saving and Investment Union. So from business side, from funds side, we turned to the aspect of people. It is very good. Another observation, by the way, was of the court that we have to develop financial literacy. But we stressed not overall financial literacy of all the population, which is a problem, which remains a problem, but especially financial literacy of small and medium enterprises that don't care about these tricky methods of financing their businesses. They go to the bank. If they are sent out from the bank, they take money from their friends. So the role of public sector, and this is national reforms. What should be the role of public sector? It was also persuasion that the public sector, commission, council, parliament will do the job and everything will function well. But the role of public sector, and this we should understand, by the way, Commissioner Albuquerque mentioned this, is to catalyze the process. And here catalysis from national governments is not enough. So I'm very happy that in the Baltic case, we had 2 guardian angels, and the first was EBRD, of course. The first was EBRD with a memorandum, with this amazing project of parallel legislation on covered bonds. And of course, European Commission also supported technically.
Another guardian angel.
Another guardian angel, yes, European Commission nevertheless. But the national governments, they are also very important. And one example that was not mentioned, Arvils, our languages, Lithuanian and Latvian, are very similar. So, but sometimes words sound a bit differently. I think if you say Altum and translate into Lithuanian, it becomes Ilte. And this is 2 institutions that launched just weeks ago the Accelerator Fund. And this is also very good step forward. So we were arguing, I'm still arguing for the public sector to be a catalyst with specific tools, of course, legislation. We can come back to the legislative differences between the countries. But national promotional institutions, I think this is also a very important tool. And by the way, we will be speaking at this conference after the lunch break on these concrete topics. So the role of national reforms is also very important. Let me stop here.
Thank you so much. Mr. Strauch, you have just published a very timely report, but I follow very much the work of the ESM, and some months ago you also published another one on Savings and Investment Union. There you put on the table some nice national examples, for instance, about the Swedish ISK account. You also drew a comparison with what's been done in France, in Italy. So what are your views between this mix of doing things at EU level and also taking forward national reforms, and how can this help increase financial stability, which is your main objective, and how can this contribute to shock absorption?
Thank you very much, Judith. And let me follow up on what I said before, but also pick up then on what was discussed in the earlier panel. On this issue of market integration and how it helps for crisis resilience, I think it's very clear. There are two key points. I mean, all of you know about risk diversification and why it makes sense to have a diversified portfolio. For the economists, at the macro level, that means if you have stakes in various countries, income flows can go across countries. That helps to smoothen output over the cycle, over different economic episodes. That helps the central bank to have a common monetary policy, because we have the European Central Bank doing a common monetary policy. That is during normal times. We know also that deep capital markets, and was discussed, provide liquidity. They give the buffers for firms to work when the system comes under strain. You have liquidity, you can access them, and they work. However, the point is, what is, so to speak, in, for example, this region, when suddenly a security risk arises? And you have this risk sharing under most circumstances. Under normal circumstances, it helps a lot, and the bank stress tests show that. But if there is a security risk in a region, you cannot expect investors to pour into the country and put their capital there. And that is why I said before, it also makes sense to have a public backstop. And let me here be, and Nicola raised the question, what can you do? Let me be here modest, but also clear. The European crisis resolution mechanism, it's us. And that is also why we are there to safeguard financial stability. And that is what we are practically thinking about. And there are two concrete points that we try to push in order to be in that position. The point number one is we have a revised ESM treaty. As part of the treaty, we are meant to become the common backstop to the Single Resolution Fund. It's another safety valve that helps to stabilize the banking system in case something goes wrong. And the important part here, it's eventually financed by the industry. It doesn't fall on the taxpayers. That's point number one. Point number two is that we look into our toolbox and see how we can help in situations like the one that Lithuania is now experiencing, or if that really were to tighten even more, the security risk becomes higher. What happens in cases of natural disaster? Is there something we can do? And we look whether our toolbox can help. And just one small example, we have precautionary credit lines. Part of the toolbox we also have is primary market purchases, which means that if a country goes to the market, for some reason that transaction would not develop the way it is planned, we could come in and support the market access of that country. And that is not to say that you must go there, but you can have a safety net that backs you up. And that is our way of thinking of, if it really goes wrong, what we can do and where the public sector can actually, or we can actually support financial stability, also forward-looking in that situation. And again, turning back to what we discussed before, where there was the trade-off between risk and growth. If Europe wants to move towards regulation that is again willing to entail more risk in the financial sector, we must also think about how we want to manage it. And one point that I think we don't want to do is to go back to a situation where the risk in the financial sector, either by the banks or the non-bank financial sector, is borne by the taxpayer. We got out of that. So we must think what is a good public backstop, how we organize backstops in situations something goes wrong. And that is a reflection that should be part of the overall system. It's something that is also on our mind, and I think we are doing our best to also gear our toolbox towards it. Thank you.
Thank you so much, Mr. Strauch. Well, I know that the reform of the treaty of the ESM has not been fully ratified. It's still one pending member state, but this does not mean that the ESM is not fully functional. Indeed, the safety net is still there to ensure financial stability of all euro area member states. Now I'd like to move to the second round, which is a more forward-looking nature. Mr. Oates, I mean, in the previous panel, there have been very strong calls for a reduction in the number of pages of regulation using ChatGPT, which is a very visual. So if you had to draw a wish list, would it be more focused on regulatory incentives and regulatory simplification, or would it be more tilted towards deepening private sector engagement?
Good question. I don't have this wish list like Tim didn't have a magic wand. I think the heavy lifting will be done by the private sector anyway, always, in case of a market economy at least. But there are certain things the governments can do and help with. First is supportive environment that allows basically foreign institutional money inflow and also the local pension funds. Help with the financial literacy development, and in general be also one of the drivers behind the capital market strategy as such. I think there is a lot to learn from history, and it doesn't necessarily repeat itself, but I've got to find that they always, well, not always, but very often rhyme. In the 1920s, in the US, there were the Roaring '20s. They followed by a crash in 1929, after what the investor sentiment was that never again, especially from the retail, that is also dominating our region so far. So what, then there was war, and so what did post-World War II look like? Wall Street was promoting an idea of a nation of small shareholders. This is, in the Cold War. So there was a campaign that ran from the 50s, almost 20 years. It was called Own Your Share. Good name, right? Own your share of American business. So people were encouraged to become shareholders of local enterprises. So during Cold War, capitalism with equity investing was positioned as a safeguard against communism. So promoting a person, American citizen, to become financially self-sufficient, it was not just an economic goal. It was also a matter of national security. So this is, 50, 70 years ago. I'm not saying that we have roaring something now, but I think there are quite a few similarities. And the sooner our governments in all three countries basically align, I think I still come back to the wish list. If I had a wish list.
I knew you had one.
I have a very small one. So I would only, yes, if I only ask for one thing, is that as we put our backs together with the Memorandum of Understanding, we also write down a one-pager. Where do we want to go with the capital markets? Whether we call it a strategy, I know our government doesn't like the word. Whether we call it a blueprint, whether we call it a vision, I really don't care. This is my wish. We have a plan. Whether we want to catch the EU average by 2030, 35, 40, doesn't matter. Because then we know what are the steps that we can take. The government doesn't have many levers. There are state-owned enterprises that can be listed, the things I mentioned earlier about supporting of the environment, so forth. But I truly believe that we are lacking it and have been lacking it for many, many years. And in order to, every business would have such a strategy in place, because otherwise, without a goal, it's just a wish that I have.
Absolutely. So we need a plan, we need a strategy, call it whatever.
Especially given that we are seeing this moving towards one single region, I think we need to collaborate.
Absolutely. Ms. Rowe, so before you were talking about the covered bond initiative as a landmark result of the MOU. What would you like to see in the future? Many things have been said about financial literacy, about the relevance this would have for the mobilization of private capital, retail investors being more financially literate. Do you think this could be an achievable outcome, or do you envisage some other strategies going forward?
Well, I would support Carol in saying having a simple, straightforward list of priorities is really the way to go to take things to the next stage. And we have a concrete landmark because we have our annual meeting, which will have a pan-Baltic focus in Riga next summer. Now, what the MSCI tells us is we need more investment in the exchanges because on the markets, because they need to be deeper and we need to have more volume. And we also need more trading. So I would look at new instruments. At EBRD, we're considering for the first time, not yet, on paper, but we're having discussions about creating an exchange-traded fund in Central and Southeast Europe, that this would be an instrument we could do here. We've done the commercial paper, which was, I think, a problem of timing. It wasn't so well received, but I think that that's something that can be revived by other companies. And I'm very excited about the IPO fund. And I congratulate governments of both Latvia and Lithuania for contributing money through Altum and ILTE, because I think that this will also serve a market that needs more investment. But how else do we get there? I think it's important to think about the utilities. Can more of them be brought to the market for minority listing? Can some of the municipalities and state-owned enterprises have bond programs as well? This all brings more liquidity to the market. So no, that's not equity, that's not what the pension funds want, but it's something that your average investor is interested in diversification. So these would be some of my suggestions. And then finally, I think for policymakers, the way forward is also looking at this important element of harmonization. And taxation is particularly important in this regard. I know it's sensitive and it's difficult, but at least having a plan to move towards harmonization could be very, very helpful. So thank you for that.
Thank you. Governor Šimkus, so we were now talking about maybe having a strategy to reach the EU average by 2030. So where would you like to see Baltic capital markets in 5 years' time? And what steps do you need to be taken to achieve that?
Well, as I said in the beginning, we can make some KPIs where we could see, the market growing, but like directionally, I would say that we want the capital market to be existent, which, so to say, provides alternative or substitute financing to the businesses of all sizes and all risks. Having said this, we talked quite a bit about typically we talk from the institutional investor points of view. You mentioned the pension funds, MSCI Baltic indexes, and how to go from the frontier to emerging or even developed level. But what I would really like to stress that it's not only about institutional investors, it's very much about local retail investors. Because we have tens of billions of euros in the bank accounts. Lion's share of this are the money in the current accounts. And it's not the story that we have savings, but we don't have investment. It's not only to Europe as such, but also to different single countries. For instance, Lithuania, Latvia, and Estonia. So to allocate that money, we need to work on instruments that are easy, that are understandable, and that are the first step to enter the capital market. Because otherwise, only with institutional investments, we won't develop it. I liked your example on this promotion for 20 years in own your share. But I would call Ministry of Finance to think about own your bond idea then. So we have a defense bond. It's a very nice instrument of limited quantity, fixed interest rate, issued, on some basis. But why can't we have a bond of 10 euro, which is traded in the capital market, which is available for ordinary retail investor who can buy it in the primary market, and which earns a decent market interest rate? Why not? Why do we have our own domestic government bond market limited to the several banks which, so to say, share it? Could this be a nice step, to increase the financial literacy and education about the investment and investments into the capital market? Because everything starts from the first step, and having so many money of people which are, I would say, risk averse. So this is something which is very much needed. So I do believe that the state government could play much bigger role than just, so to say, regulating the market or reducing regulation or making a plan. It's also about like a role of catalyst, which could make the market grow.
If I may, a follow-up question: do you think that tax incentives should be considered in that catalyst role?
There are so many tax incentives already in Lithuania, so it's not. So I do think that we don't need another tax incentive. We need to work on those many tax incentives to put them under one umbrella. So we have this investment account, which needs a little bit more work on this. But we have also some other tax incentives. So it would be. I wouldn't think that another tax incentive is needed. We need to streamline all these tax incentives.
Okay, thank you so much. Minister Saradens, so I understand that, and I very much welcome the cooperation between the three Baltic countries, but I understand that also at national level you have your own national reform agenda. So how do you make this compatible?
Well, we're trying to coordinate everything with our lovely neighbors, that's for sure. There are, if you're talking about national agenda, I think I would like to start with infrastructure. I think it's fine, but I already mentioned that we working on interoperability with security depositories, and this I think is important for all three countries. And then I will switch to, let's say, our national agenda, and then I will start with supply part. One is we're trying to stimulate a bond market, and state entities are emitting bonds now. Latnergo, recent announcement on 1 billion euro bond investment, let's say emission is a signal of that. Then we're trying to stimulate market with state bonds. The government actively selling state bonds. There are some success stories, but that's again gives market the idea what should be investment. And right now we're considering it's a little bit more complex idea, but about acquisition and merger funds in order to, how to say, what Mr. Otz said, sizes matter, and in order to somehow, how to say, try to move companies in order to merge, yeah, to have a bigger size and have a more operating capital and need for capital to grow, yeah, and that we're considering. On demand side, I fully agree. We have to a little bit look into taxation issue, and if we look on Swedish model, there were created quite a setup for private investors, private investor taxation system, and that's, I think it's fundamental. And next, of course, we all discussed, and that was nicely put, examples of investment culture. Yeah, there are two things. I think it's, they were mentioned about how much done on literacy, but we saw the numbers, it's not enough. And I think we have to not even speak about literacy, but we already have to speak about some kind of, let's say, Baltic saving model. Yeah, if we compare like Scandinavian and Anglo-Saxon models, they are different. And I think in this context, I would say we should consider more ideas to move closer to Scandinavian trading systems and bring better ideas from there. Yeah, that's it. And I think my bank governor will kill me, but I say that. But I'm really like lovely ASM idea about. Thank you, Mr. Strauss, for that. To maybe we really have to start consider about single regulatory mechanism, and I think that could be a good role model for But this could be a good role model, and I would like to finish with this as very interesting as Europe right now put on agenda the single capital market, and Baltics is somehow a role model how it's done so far, and I think it's Baltics is a good, I would say, soundbox. Of course, there is the drama with shallow market and liquidity issues, but it could be a good place for experiment, and because it's small, yeah, and you can swiftly can change if you're mistaken on this. And I would say, on my view, there is a great formula for Baltics. Small, imperfect, not perfect, imperfect, yeah, and fast, yeah. That could be a good move for Baltics. Thank you.
Thank you so much. Mr. Strauch, before you were referring to the safety net that the European Stability Mechanism provides. I also see that you are now playing a policy advisory role, as we saw with this policy paper. What I see is that there is a lot of heterogeneity across capital markets in the EU, and then, I mean, this panel and also your presentation very clearly shows this. How do you think this can have an impact on financial stability, and how do you see these projects, these ideas to build the regional capital markets, how do you see this can positively or negatively affect euro area stability?
So from my perspective, let me span this picture a little bit broader. How can Europe help with this? And I mean, obviously, with the Commissioner in the room and with Verena Ross in the room, there is a big role that Europe has to play in the integration of markets, on the regulatory, on the supervisory side. What comes next to that? What can European institutions do? I mean, I just talked about us as a insurance, as the firefighters, and we have 430 billion of lending capacity, and I think this is a sizable insurance. But other institutions are in the picture as well, the European investment banks or the Nordic investment banks, so supranational banks that can help, and the key role of those is take risk. I mean, take risk out of the market, make financing possible, even in situations where it's otherwise not done in the national market and cannot be done in the national market because you don't have the means or you don't have the scale. So support markets in that regard. And I think the EIB has a very long tradition on that. The EBRD does it also. The third element then is the European Commission. And I think here is a very good development also with the proposal for the new budget
of the European Commission, the next 7-year plan, because it tries to integrate more national reforms efforts into a growth initiative and gets out of a pure distributional scheme. And I hope very much they can make progress with this. And they also earmark funds to scale up companies and to finance growth in a different way. And here, obviously, it's a complementary role because you need to finance maybe infrastructure in order to make progress and actually have some suitable projects. So I think there are different roles that come into play here, and that combined is what, I mean, in terms of big themes or points that we have. In Europe, we should work with the principle of subsidiarity. You do at the national level what you can, but if it is beyond your means, or if it's more efficient to do it European-wise, then please do it at Europe.
Okay, very well. And last but not least, Mr. Satsius, I'm going to be very naughty, so I just want you to pick one reform that you think would be key in developing Baltic capital markets in the coming years. Only one.
The history tells that this approach of one bullet, one magic wand is wrong.
Okay.
And a very good example was in 2020 when the European single access point was of financial data was proposed. I can remind this story. The idea was put forward by the working group led by Thomas Wieser. Maybe in the audience somebody recalls.
He used to be my boss.
Okay, fine. So it was a really, really good work, but the idea was, okay, a SAP, this European single access point, will solve everything. The legislation 2023 implementation, Verena knows July next year, 6 years. I think such kind of thing for Baltic market could be useful, but in fact, I can list several, very shortly, several issues. I already mentioned the development banks. They are crucial, to my mind, for developing capital markets to foster developments there. Now, if I were still in office, Arvils, during the lunch break, we would have signed a memorandum of understanding on doing the things that you proposed. And the first, I think, very good idea by Rolf Strauch is unified tax treatment of investment account. And development of the mechanisms, taking example from the very good Swedish model, which is also a work in progress. But then I agree very much with Gediminas Šimkus that what we need is a simple, transparent, IT-based investment product that could be promoted among the citizens for not to spare their cash in the banks.
That could be your single reform.
Yes, this could be a single reform, and I think in Lithuania, I understand there are different views on this second pillar pension transformation that was approved by the parliament last year. I was a kind of a part of it because I belong to the coalition government that proposed this reform. I think now, as decisions have been taken, not everybody likes them. And people are waiting what to do with the money that they will have a possibility to withdraw from the pension funds. It is for you, dear representatives of the private sector, to think about new investment products that would be simple, transparent, IT-based, and I would suggest, maybe in some cases, patriotic. I mean investment for financing defense industry in our country. And I think the idea of the single pension product, long-term investment, that is another problem, approved by the 3 Baltic governments, could be a way forward, although very difficult because we do have experience, not very positive experience with Rail Baltic. But I think we can negotiate also this joint 3 Baltic states pension product. So these are my recommendations.
Okay. Thank you so much. So we don't have time for the golden minute. I'm so sorry, but I mean, time's already up, but I'd like to open the floor very quickly for any question that you could have, or if not, of course, during the lunch break, we can also exchange bilaterally. Okay, we have one question there.
Hello, my name is Gintautas Mežetis. I represent the Lithuanian Business Angel Network. We invest into the risky things, and we drive discovery and new talents of ideas, which drive our economy later. But we take the risk. At the same time, we are double taxed if we use SPVs, limited liability companies, pooling our funds to invest in startups. So I ask to look into this issue in Lithuania and just extend our investment account with ability to use this thing, investing and expanding the capital access to the markets.
Okay, so we have already a request for Lithuanian national authorities. I know if you would like to react. Okay, thank you so much. You were brilliant and you deserve a very strong round of applause.
Thank you very much. I think this is now time for comments and reactions, but this will be done, I hope, over lunch, which will happen in the first floor of the hotel. So just go down a little and please be kind to come back at 1 p.m. to continue with the other topics. Thank you. Welcome back, everybody. I hope you really did enjoy your lunch. Did you? Did anyone enjoy their lunch? Would you raise your hands for the sake of interactiveness? Yes, you did, but not everybody. But I'm glad that you're back. I hope that others will follow you. We have 2 super important and interesting sessions to follow. One last hand raising, if I may. Did anyone learn anything new in the first or the second session this morning? Thank God. More hands raised than people who enjoyed their lunch. So I'm going to continue talking not important things because I know that this way I will attract people to come because they will know that something is happening on stage already. The doors are closing, so there might be less of you during these 2 sessions. That always happens in the afternoons, but let's not worry. Those who really care, they will be back, and we will have our audience back, I hope. We will continue working in the same manner, a keynote speech followed by a panel discussion. And I'm really excited to invite on stage Vice President of the European Investment Bank, Mr. Karl Nehammer. Welcome, the floor is yours. We are happy to have you with us.
Thank you very much, dear ladies and gentlemen. It's a privilege to address you today and open an important discussion on how we can mobilize investment in light of geopolitical challenges. The EIB Group is proud to be a long-standing partner to Lithuania, active here since 1994. Over the past 30 years, we have worked hard to work hand in hand with both public and private sectors, financing 76 projects and investing nearly 5.5 billion euro to help the Lithuanian economy flourish, promoting innovation, supporting renewable energy, and improving infrastructure and security. Earlier today, we signed a 300 million euro loan with the Lithuanian Ministry of Finance for the financing of defense infrastructure and related investment needs to make Lithuania safer and more resilient. This is a strong testament to our partnership with Lithuania and our committed support to strengthening EU crisis preparedness and cohesion along the Baltic border. The Russian invasion of Ukraine has brought Europe's security to the forefront. A new challenge arises. The EIB Group is evolving to meet them. Since 2024, we have significantly increased our support for Europe's security and defense capabilities. Our scope now extends beyond dual-use investments to include purely defense-related initiatives. In line with the mandate from the member states, this year the EIB and the EIF boards adopted major revisions to our lending policies. European security and defense is now fully integrated into the EIB Group's core mission. These reforms demonstrate our readiness to remain responsive and relevant in a rapidly changing global landscape. Complementing the European Commission's ReArm Europe plan and the White Paper on European defense, both strong testaments in the EU's unity, strength, and commitment to close cooperation. The White Paper underscores a dual imperative. While increasing defense spending is essential, such investment must be strategically focused to deliver the greatest collective value for the EU. This requires deep collaboration among EU member states and reliable partners, a principle at the heart of the EIB's investment philosophy. We seek trustworthy partners and co-investors who share our vision and capacity to create solutions, close market gaps, unlock private capital, and make Europe more competitive, sustainable, and secure. For the EIB Group, security and shared economic prosperity are mutually reinforcing. One is a condition for the other. The foundation of European security is a strong, productive, and innovative European economy. Let me now turn to the scale of our ambitions and how we are coordinating our efforts across Europe. Looking ahead, our ambition is clear. In 2025, security and defense will represent at least 3.5% of EIB Group finance, with a pipeline of over 30 flagship operations. Among these is a 540 million euro loan for the Lithuanian military base, for the German brigade, and a landmark operation paving the way for similar projects in Latvia and other member states. We expect approximately 3.5 billion euro in security and defense signatures this year. 2.6 billion euro are already signed. We are working closely with the European Commission to ensure EIB financing complements the Security Action for Europe, the so-called SAFE instrument, maximizing the impact of available public resources at the EU level. By working in tandem with the European Commission, we mobilize even greater volumes of finance for Europe's security and defense priorities, ensuring every euro delivers maximum value for our citizens. In the near future, we will emphasize support for the eastern flank, anti-drone technologies, military mobility, and the protection of critical infrastructure. EIB support focuses on 5 key areas. First, critical infrastructure. This means military bases and related infrastructure, border protection, and cybersecurity. Financing is provided either via direct lending to member states or through PPP structures, as demonstrated by the new military base project. Second, industrial scale-up, boosting industrial capacity in critical areas, including advanced drone and anti-drone manufacturing, logistics for defense equipment, and satellites. Third, research and development of advanced technologies, investing in cutting-edge research across cybersecurity, optics, robotics, and other innovative defense technologies. And we support both promising startups and large-scale R&D programs of leading European contractors. Fourth, financing for SMEs. SMEs are the backbone of Europe and a key component of the security and defense supply chain. Scaling up the industrial base depends on their capacity to grow and access credit. For example, our 1 billion euro pan-European program for SMEs active in the defense supply chain has now tripled to 3 billion euro, following strong interest from financial intermediaries. And fifth, supporting private investment funds. Through the EIF's Defense Equity Facility, we invest in venture capital funds exclusively focused on security and defense. Ladies and gentlemen, our challenges are real but not beyond our reach. With vision, commitment, and cooperation, we can invest wisely, building resilience, driving growth and fostering innovation. The EIB Group remains fully committed to the European security moving forward. Thank you.
Thank you very much for your presentation. If you'd like, please pick one of these chairs. Thank you for listing the 5 priorities. I think we will build on them during the panel discussion, for which I would like to now invite the following speakers. Minister of Economic Affairs of the Republic of Finland, Sakari Puisto. President and CEO of Nordic Investment Bank, Andre Kysvek. He said that you can be as long as I wanted, so I did a long one. And head of Baltic Division at SEB, Nina Eikas. Welcome. And one chair is left for the moderator. The panel will be moderated by the Chief Executive Officer of National Development Bank of Lithuania, Ilte Dainius Vilčinskas.
Good afternoon. Nice to see you at our conference here in Vilnius. First of all, let me introduce myself. Živilė said several words about myself, but I'm Dainius Vilčinskas. I'm a CEO and chairman of National Development Bank Ilte. Ilte is a state-owned institution that is helping to Lithuanian economy to develop and to grow by filling in the gaps that we still have in the financial sector, in the capital markets. And Ilte is having as a strong mission to help Lithuanian economy to evolve, but at the same time to help to finance country priorities. And national security, defense sector, country's resilience is one of our top priorities. And from Ilte side, we have already allocated at least 300 million euros through different instruments, direct loans, equity investments, venture capital investments for a defense and dual use sector. And we are going to allocate even further more funds to the sector. And the fact that we're having this discussion here in Vilnius is very symbolic, because Baltic countries, Lithuania, Latvia, Estonia, Finland, Poland are extremely exposed against Russian aggression. And here in the panel we have experienced persons representing public sector, governmental sector, private financial sector. And I think only good dialogue and practical discussions and agreements are the ones that could help our countries and in general the whole Europe to become more resilient, more safe. And this whole sad geopolitical situation at the same time creates opportunities to become stronger, but at the same time to strengthen our economies, to advance in the technology field. But for that we need funds. So I would like to ask everybody on the panel to share their views. How this war ongoing in Ukraine has changed the attitude towards financing states' securities and states' resilience. Carl, maybe you would like to start?
I mean, I think it changed everything. I was prime minister in the time when the war started against Ukraine, and we had a lot of councils in this time. And you could feel and see that this war, this breaking rule of Russia will change everything. And you can see the impact also in the EIB, because till March 2025, it was not easily possible for the EIB or EIF to finance security and defense. But the time has changed. The board represents the member states, the owners of the bank, gave us a new mandate. And now we have the possibility to finance. And you can see it if we tripled from 1 billion to 3.5 billion, only in nearly 1 year.
Okay.
So, I mean, you can see which kind of really tough impact this war had.
Maybe, yes, Karin?
Yeah, the war in Ukraine changed a lot in Finland, but not everything.
Okay.
Because we were, I would say, in comparison with many, if not most nations, quite well prepared militarily. So we had a long tradition, we have a strong conscription-based armed forces, and we never let it down. So there's a compulsory military service for all men that has been for decades, and we have had a relatively robust defense spending already before the outbreak of the war. That was even before we were a NATO member state, it was close to 2% actually, the NATO target. But since then we increased, of course, the defense spending a lot. So now it's currently about 6.5 billion euros. The increase for this year from the previous year is about 500 billion, and we are getting to the 3% by 2030. So then we are spending 10 billion euros annually, which is a lot. I mean, but that's where Baltic countries are at already. And considering the resilience we have had for decades, the agency called National Emergency Supply Agency, so essentially like stockpiling, and a state institute that has done a collaboration with all main industries. Financial sector is part of that, chemical industries, logistics, you name it. And in collaboration with the private sector, essentially thinking about the different scenarios and ensuring the supply chain security. So we have that tradition, but also that has changed to be, I introduced just 1 month ago in the parliament. I'm also a member of the parliament, so I introduced a new bill to renew that law. So we changed the organization, and we are actually going to increase the finances for that in order to have it at a reasonable level, at the current level. So and also, of course, we see this also as an opportunity for the defense sector, for the critical technologies. We have quite good sort of edges there on the space sector, dual-use sector, and also the traditional military capabilities like armed vehicles or explosives or the shipyards also to produce the naval vessels. So, but yeah, it certainly puts a very significant pressure on our fiscal situation, which is not easy. So we are running quite a serious budget deficit.
Okay, thank you. Andre.
From my perspective, I think first I should say that with the hindsight, I think we should say it was not a massive surprise what happened February 2022. We know we have a big, unpredictable and potentially dangerous neighbor in the east with imperialistic ambitions. So certainly for most people in Finland, Estonia, Latvia, Lithuania, it was not a big surprise. Sometimes these things, of course, come gradually. So to say that the war started 22 is wrong. The war started 2014 with the little green men in Crimea. Now, let me give you two perspectives what has changed. And I give the first one from the perspective of a responsible citizen, and the second one as the leader of the Nordic Investment Bank. First, as a responsible citizen, I would say, you know, when you look at the picture, then most pictures are 2D, but the world is 3D. And the same can be said about challenges. I think the world before a full-scale war in Ukraine was 3 big Ds in terms of challenges: demographics, digitalization, decarbonization. And I think we are now moving from 3D world to a 5D world, where there are 2 big new Ds coming. One is defense, and the second one is deglobalization, also having to do what's happening on the other side of the Atlantic. So that's my citizen view. Secondly, as a leader of the Nordic-Baltic Investment Bank, we have changed drastically as to what we think we can, and even more importantly, what we think we should do. In terms of the defense sector and potential financing, we kind of split it into 5 different groups, where the first group was do nothing, not even dual use. And that's where we were before the full-scale war. We didn't do dual use. Second group is dual use. Third group is military and defense, with the exception of the weapons and ammunition. Fourth group is everything, including conventional weapons. And then group 5 is the unconventional weapons. We moved with the full support of the ministers, our governors, 8 countries got together in early spring 2024. And we moved straight from group 1 to group 3 with the promise that we will look again in a year's time. And that year's time came this year, when we also opened ourselves to finance actually weapons and ammunition. And we have now done the first few defense loans. There is a very big universe of companies, some more known than the others, but there are ecosystems and suppliers behind it. So since we are in Lithuania, when Lithuania asked us on the 8th of May whether we can do a defense loan quickly to the government, then we said we will. 12 days later, we signed the loan agreement for 400 million euros here. Okay. So we can move fast, and we will again if need be. Thank you.
Thank you. Nina?
Yes, I have also many personal views about this situation, which probably it doesn't look too good in that sense why the world is going that direction, what it is going. But representing a bank and being a kind of a SEB commercial bank, so of course there has been a lot of things that has changed, and the bank and the investors, everybody has in a way had to change their thinking almost like 180%. What to do, and then also Sweden and Finland joined the NATO so that the bank's own sector policies would reflect the fact that what is happening in the overall security market. But I think also that it needs to be a somewhat more broadened view in terms of security and defense that is also deeply integrated with sustainability, and SEB has always been very active in kind of helping the resilience of the economies and creating better societies. It could be anything from infrastructure, logistics to better communications, cybersecurity, and so on. So it doesn't only have to be, in that sense, directly arms or defense related. And then the other one is, of course, what had to change was to have a broader mandate in the asset management, and in a way have the funds be able to invest in more broadly in defense and security. We have also just newly this fall launched a thematic fund from SEB Asset Management, which is largely investing in European defense and securities, and we will, it's actually available already now in Lithuania through our private banking, and we hope to then broaden it to cover the whole retail banking universe in the Baltics. So there is a lot of things happening, and SEB is very active.
Mm-hmm. Okay, thank you. So it sounds that things have changed drastically, and defense financing becomes a new normal, and almost every financial institution has this sector on its agenda. But let's look a bit from a policy perspective. And Sakari, I'm looking at you again. You are representing government, Finnish government. But as well, I believe you are having intensive discussions in Brussels on the EU level. So from a policy perspective, do you see what are the main obstacles or barriers that still hinders the sector financing, the availability of financing for the sector?
Even though you said that, ask me about the finance, yeah, there are limiting factors there, but I think ultimately the fundamental limiting factor is the limited availability of the military equipment and the industrial capacity in Europe, and that's the limiting factor. So how fast can we scale up the defense industrial capacity in Europe and also in the allied partner countries? That's the ultimate factor. But I think like at the European Union there are good vehicles on this safe as the front-running vehicle MFF. We are having the discussion on the Competitiveness Fund and the use of that in dual use. So that's one factor. But I think critically it's about what you actually said in your opening speech, that how we can have the maximum impact on the defense procurement. So essentially how we can organize that procurement at the European Union level that is optimal to use it at that scale. So in the procurement and at the collaborative scale.
Okay, thank you.
Maybe I just add about also the national vehicles we have, because all these like national promotion vehicles, what we have, like the industrial investment vehicle, the export credit agency that does the specialized finance, Business Finland. So all those are actually tuned to the defense and dual use already. So.
Okay, thank you. We talk a lot about defense financing, but I think there are two sides to this topic. One is defense spendings. The other one are related to growing the industries, incentivizing establishment of military technologies, kind of new startups. And here, I guess the availability of funding in different forms is critical. And now on EU level, we have different programs, such as European Defense Fund, SAFE initiative. And this is a question to all of the panelists. What is your guess? Which of those initiatives could be the most successful, and what are the main flaws that they still have? Andre, I see you have a...
Well, yeah, you see me smiling, but I'm sure Carl is sitting closer to the European policymakers. Now, I hope answer to your question should be they will all succeed, and
Hopefully.
that there will be even more. And I think it should not only be in the hands of EU policymakers and EU budgets. I think a lot of it is sitting with the national, be it export credit agencies or other guarantee agencies in the countries. Because as a banker, what I see, many of these projects that desire financing, when we talk about, ramping up manufacturing in our own countries, suffer from very much the same problems that most other banking projects. You need some sort of a completion, risk mitigation, then you need to have some sort of an off-take risk mitigation. And I think this is where, we feel that, okay, there are some of the big names, and to mention maybe some of the big Nordic ones, of course, Saab, Kongsberg, Patria, Namo, etc. They have access to bank funding. They had it even before the IFIs woke up to the idea that maybe defense financing is a good idea. But then there is the whole ecosystem of component providers, suppliers that are not really bankable. And I think that's where we need some of these guarantee schemes, and maybe also for the IFIs to do more. For instance, and that some of these initiatives can come from the private sector. For instance, the first defense bond investment we made into Lithuania, Vika, the state-owned investment holding, issued a 25 million euro bond, of which we bought 6 million. That's the first one under the Nasdaq new kind of a defense framework project. So I think we all need to stretch a little more, and the critical times, of course, put pressure on us to do it smart, to do it fast, and then move decisively.
Thank you, Nina.
Yeah, thank you. I think that actually both mentioned initiatives are good. They are kind of a mixture of grants and loans and bonds. So in that sense, but I think coming what Andre said, it is true that in the end of the day, from banking perspective, they are still investments or projects that needs to be bankable. And I think there is maybe some analogies to think about how the energy transformation and the green transition started at the beginning, when there was quite big, there was guarantee schemes available, and there was also price guarantees for the electricity. So I think something like that maybe should also be considered, so that these investments really start going.
Carl?
You know, for me, it's such an interesting question because I changed my role. In former times, I was policy maker. Now I'm a policy taker.
Okay.
And what this means now for me is that I can really say, as a representative of EIB, that our plans align totally with all EU initiatives, like Rearm Europe or the European Defence White Paper. And I think this is the fascinating role of the Nordic Investment Bank or the EIB as well, or the EIF. We can help to close the gaps which are still existing in financing, and to help that startups have a perspective, not only in research, but also afterwards in performing on the market. And I think these are now our goals as in the EIB, and the EIF. I mention always both because we are really a group, and we have various offers to find ways to finance projects, and not only public, also private, and public-private partnerships. I think we have now a lot of experience.
But staying still with you, Carl, you are very close to EU policymaking, and are there any still changes that you would anticipate that could enable EIB to do more in the sector?
Well, if you look to the past, they changed a lot already. Yeah. But you know, the question means for the audience, we are not allowed to finance ammunition and weapons. This is the difference between us and the Nordic Investment Bank. We are allowed to, and this is really new now, to finance everything else what security and defense needs. So this is the same for EIF and EIB. And this is also reflecting to that what I mentioned before. You know, the EIB is led by the board, and in the board there are the representatives of the member states. So if the prime ministers or the governments decide that EIB should also finance weapons and ammunition, the board could do the decision.
Okay.
So it depends. I think we are living in so fast times, everything is changing. So I think maybe it will, when the member states say, okay, now we need the EIB and the EIF also for financing weapons and ammunition. But it's a decision of the board. It's not a decision of the management committee.
Do you feel it's coming?
There is still a discussion, you know, and the pressure is rising. So I have no glass ball, you know, where I can look through.
Okay.
But I think, yeah, I think that it's really hard to predict. But what I can say is there is still a discussion. Yeah.
Okay, thank you. I have one very practical question. From ILTA side, we are as well considering providing financing to various defense-related projects. Sometimes it's a factory to produce weaponry, kind of explosives. And while considering financing, and if this is kind of greenfield or project financing type of case, then you search for offtakes and you try to assess the risks. In case of a defense, this is a bit of a challenge because some of the sales contracts are classified. So could you share your experience? How do you assess the creditworthiness? How do you mitigate the risks? Or maybe there are some regulatory kind of easing for the financial institutions to be more flexible and have an appetite for this type of exposure in the books. So how you do defense financing?
Well, first of all, it is really good if EIB or EIF or the Nordic Investment Bank supports project because it's then interesting also for other investors because our reputation is so good that they say, okay, if the Nordic are inside or the EIB or the EIF, then we can trust. Yeah, I think this is my personal point of view, so I have to be careful because I was a former politician, so it's not easy not to be a political animal anymore. Is, you know, this question of risk management is also a question of how the SDGs are defined. You know, so there are some warnings that maybe if EIB is financing ammunition and weapons, maybe our ranking is going down. So now we have to come over this discussion, I think, but also the Commission, also, I think, in the aspect of financing, yeah, security and defense, and especially also weapons and ammunition.
Okay. So if the answer is whether we can share experiences, then if the question is whether we can,
that's an underlying question.
The answer is no, because we don't have the experiences, is the very honest position. We have only started. We have already figured that even mapping that sector is more difficult. And the question is not how we could internally handle it. Of course, we have the thresholds for anything from confidential to strictly confidential to, you know, only insiders and then classified. We can handle it all internally. But to get that information from the counterparties and then to be able to check the integrity and compliance factors is challenging. The other thing that is challenging is that since, you know, if we exclude the Prigozhin army type of establishments, then the ultimate off-taker for weapons is the state.
States.
And it should be the state
or
states. So, and that has to do with the you know, length of these off-take agreements. You know, when we finance an electricity plant, we know that, look, we can, or a wind park, we can ask for an off-take for 10 years, 15 years, 20 years, and we still know that 25 years from then, somebody needs electricity. Now, if we finance a weapons factory, that's more tricky because the governments operate based on, you know, annual budgets and then maybe 3-year forward-looking view, but not that much ahead of that. So we are not talking 10+ years here. So, in the end, there is also the question which has a little bit to do with the kind of ethics, etc. Fine, we produce all these weapons, so we have have them stored somewhere, and hopefully we will never need to use them. And if we never need to use them, then what happens to them in the end? What do we do with it? You know, do we allow the governments to sell it to whoever wants it next? So there are a bunch of more complicated issues that there would be in other sectors.
Nina?
Yeah, I can only echo. We have very similar principles in that sense. And I think that's the whole crucial question, of course, that how long-term beneficial that investment is, that if we're looking at the GDP combined for these 3 Baltic states, I think it's somewhere around 160 billion euros, and if the 5% is going to the defense and resilience, we're talking about money like 8 billion, which eventually has to be sourced somewhere from the budgets, and the more possible it's generating cash flows and wealth and resilience, innovation, R&D for the long term, it will be beneficial. And of course, this type of greenfield projects, which are simply for ammunition, and those are much more difficult in that sense as well. There needs to be some sort of long-term views on this.
Okay, thank you. Sakari, maybe I can ask from your perspective, because financial institutions are struggling, like Andrea said, it's really hard to assess the risk of the project. In many countries, weaponry is produced by so-called primes, and usually states stand behind the primes. But now we see more and more private capital being invested into dual-use and single-use technologies, because business sees the kind of business case. But still, how to help the credit institution to assess the cases? Can governments help somehow?
I'm not an investment banker, so the sort of credit, but I think it comes back to the question about the long-term viability of the investment. Well, unfortunately, so I consider that we have the horizon, which is not that great from a kind of security perspective. But on the flip side of the coin is that the horizon for the sort of increased fiscal spending is there for foreseeable future, essentially. But I think like with all these public measures and procedures, yes, the investing is getting there and leveraging the private capital with a factor of 3 to 5. So I think private sector is absolutely needed, and whatever like credit guarantee mechanisms we can build or blended finance, I think that it helps with the benchmarking in the credit decisions. I think like maybe we can also utilize some of these European sort of IPCs, these important strategic projects, and also the innovation council measures there, to having like a consortia. That's one way we can expand the capabilities. And one thing I've been also thinking is at the early stage, or kind of lowest technology readiness levels, that there in the risk capital sector, I think the innovation hubs and the accelerators and Diana, the innovation forums are quite critical, and there, of course, like the public sector, the granting schemes and loan schemes come in.
Okay, thank you. On European level, when it comes to defense financing, technology financing, we have NATO Innovation Fund, we have Diana Accelerator. So those are pan-European, where new technologies can apply and get financing, and we see time from time that some of the companies are getting allocations. But coming closer to this region and in general, Nordic Investment Bank, European Investment Bank, those are big international institutions. Do you see how you could, I don't know, strengthen the cooperation with local development banks like Kilto or Altum or Finverra to unlock even more of funds for the financing of the sector?
We already do, by the way, both at the national as well as national level and then more regionally as well. We work very closely with these guarantee agencies. I mean, Finverra, you mentioned, has been a long-term partner for us, and we continue that relationship now also on the defense sector. We have been seeing also some of these first joint procurements, Finland, Sweden, Norway, Lithuania, Estonia, Netherlands, for instance, having a joint procurement for the Swedish manufactured infantry fighting vehicles CV90, which is the BAE Systems Hägglunds Swedish factory. Internally, we are also adjusting. Speed was one I said we can accelerate, and we have. The second one is we have significantly lowered the minimum project size. So, very recently we were still talking that we wouldn't do projects where our own participation is less than 20 million, and given that we don't want to finance more than 50%, that means that the project had to be 40 million. We have now said, hey, if need be, defense sector, we do 5 million. So we are perfectly okay with a lot smaller projects. And then there are a few other more technical internal things where we streamline.
Okay, thank you. Carl.
Yeah, I wanted to say the same. We do it already, and especially EIF. EIF also with ILTE. I think more than 1 billion euro already in cooperation guarantees is invested also from the EIF. So I think this is the best way in our, I think, portfolio we have, Nordic Investment Bank, EIB, with the EIF, for example, to bring money to the small companies, because the EIF is giving this kind of guarantees to the local bank, and the local bank can directly give loans to the SMEs, for example. So this is, I think, how we have to think. We have to think out of the box. And security and defense, I think, means so many things. If you think about investing in energy, infrastructure, it also can be consumed under security and defense. To be independent from fossil energy is a strategic goal of the European Union. And to invest in infrastructure, and this is also the genius side, I think, on dual use. Yeah, it is, because you can use it afterwards as well. If we don't have, maybe in the best way, not to prepare for war anymore. Yeah. So it is a good investment in infrastructure, good investment in energy, good investment in transmission of energy is so important now. And I think with these various ways to finance it, with EIB, Nordic Investment Bank and others, and the EIF, there we have always to think about the small ones as well. Okay. And I think now we have this kind of instruments, and we have to inform a lot about it, because sometimes, the knowledge is not as big as it should be about that.
Okay, thank you, Carl. Nina?
Yeah, I think you need also a lot of cooperation, and I think there's also very good examples of cooperation, like when there was this detachment from the BREL in the Baltics, how smoothly it went and how well that was done in a cooperation, and then other like infrastructure project, for example, the Rail Baltic, which probably is not really lack of funding why that is not proceeding, but more on other like agreements and cooperation things. So, but there is exactly what I also said before is that the umbrella what you can do on in terms of investments to grow the resilience of the societies, it's very large. It doesn't necessarily have to cover only this weapons part.
I very much echo that, and I think we should not underestimate also the civil side of defense, because in the Nordics everybody talks about the total defense, which consists of the military defense and the civil defense, because if there were to be the worst to happen, and if we were to find ourselves in a war, then what happens on the civil side is super important. And I think, if there is one country that can be looked up as to how they have organized itself is Finland. You need to make sure you have protection for your people, bomb shelters, a whole planning of it, because, Russia thought Ukraine special operation will last 4 days. It has now lasted 4 years. One needs to be resilient and have the endurance throughout that process. And you can only have it if you have the civil side also very well planned and prepared.
Yes.
Yeah, I mean, it's almost astonishing. Like for instance, when I grew up, I mean, we have like the civil shelters, which is like 90% of the population or something like that. So essentially for everybody. But for instance, when I travel, I was in the president's delegation to Japan in the summer, and we met basically the whole Japanese leadership. And for instance, they say that they have like some shelters, but they are actually more what I would call like meeting points. So like schools or something like that. So they are like, I think this emergency supply thinking, or comprehensive security or total security, what do you call it? I think it's becoming like an export product as itself, and resilience.
Okay. The investments into infrastructure are critically important. But the fact that in Ukraine there is an ongoing war, in Israel there was active war ongoing as well, and those two hot areas they incentivize development of new technologies, completely new technologies, that there is some sort of breakthrough. And from Ilte perspective, we provide financing to accelerators, to new startups which develop technologies which in the future, I guess, will be applied in a civil world. And those technologies, well, I guess, will contribute a lot to the wealth of our societies and to the development of economies. So I guess to provide financing, which we know all how to do, is very important. But as well important is to help those new companies to emerge. Some of them will fail, but some of them might disrupt the current businesses. The other question important: Baltic countries, Lithuania, Latvia, Estonia, are very small. Financial markets are small, available funds are small, but at the same time, countries' needs are really big. In Lithuania alone, in military infrastructure, military housing, training grounds, during several next years, there will be like 4, maybe 5 billion euros invested. Do you have an advice how those 3 small countries can obtain more in terms of financing availability for the investments? This is a question to everybody.
Well, I'm not the finance minister of anything, but I would say one needs to be able to tie up the short-term needs with the long-term development. And I think where you started, that some of what is being needed for the military and the development that happens at that high end could become usable in other situations. And I think that kind of a technology investment, and then if you need to borrow, you need to borrow. You try to leverage yourself as much as you can. You need to also take risk, but find equity investors. You need private sector to be involved. There is plenty of money in the world. One needs to be able to attract that into the equity, and then there are other layers of capital, from subordinated to mezzanine to secured senior, etc. And then basically trust that you are picking the right projects. In banking, I think super important that banking is not just about handling other people's money and lending it out and then going to play golf. It's really analytics, it's know-how, and finally experience. And if you combine these things, you normally get to the right point. Sometimes you make a mistake and then you learn from that mistake. Next time you're more experienced. The technology is very important. We are lagging behind in Europe. The pre-lunch panels here, I was listening and I was thinking that, God, when we think where the money is being invested, we talk about the, savings and investment union, capital market union. When we now look in the Americans, invest their money into American technology. See what's happening at Nasdaq, right? The Chinese now are very cleverly investing Chinese money into Chinese technology. And the Europeans are investing into real estate and into American technology, pension funds. So we need to change that whole mindset. So I think what we're discussing in this panel should be very closely linked to what was discussed before the lunch.
Okay, thank you. Carl, would you like?
I think a key word is also collaboration and cooperation. Yeah? I want to give you an example. I was really fascinated when I visited the Baltics that there is a new concept of financing companies, Ukrainian companies in the Baltics. For example, if they produce drones. Why? Because the Russians need nearly 1 year to detect where drone production is, and then it will be destroyed. So this is the reason, for example, why our office of EIB and EIF was damaged or destroyed in Kiev, because nearby is a drone factory. So it was a collateral damage, you could say, from the Russians. So that means we have to find new ways and think out of the box and create a win-win situation, because with this kind of financing, you have also an invest in the Baltics, which is useful for Ukraine and means that it is in the thinking of collaboration and cooperation the best way to use the money which exist. So I think also it is, but it's not only for the Baltics, we have to be honest. We have to do a lot in the European Union to think about how we can invest the money in defense efficient. And to have really the value chain in the European Union and not outside. It will not be possible in every field, but we should try to do it. And we have to think about Nordic Investment Bank as well as EIB, and we have to think about kind of incentives to motivate more and more member states to collaborate in the question of financing security and defense, vehicles, whatever, ships, drones. So I think we have really to do a lot, but I think there are enough possibilities to solve these problems.
Okay, thank you.
We were sitting over lunch with Nicolas and discussing whether this defense investment is kind of a one-off expense and then basically sitting and standing there, or is it something that can generate growth? And I think that's that's where we need to focus, that it will also generate GDP growth.
Okay, thank you. Nina?
Yes, and for the startups and all these new technologies, I mean, despite that they are also working for defense, they still have the same problems that any other startup would have. You need to have a proof of concept, you need to get the risk capital in, you need to scale your business, and I truly believe that you also need to have private sector scaling it up and helping it, that it will not be only done by different type of government schemes. And there I think the collaboration becomes very crucial within Europe, and also what we were discussing about the whole competitiveness situation in Europe. How do we kind of make Europe one home market for us, that when you're then doing this scaling that it at least is not then hindered by different type of legislations in the Europe.
Thank you, Nina. Yes, Sakari.
Yeah, coming back to the competitiveness, I think we are like at the European level, like lagging behind in the venture capital and private equity market developments, but not entirely. I mean, there are regions within the European Union that have done actually incredibly well. And for instance, in Finland, I would say that we have been developing quite well for the last 15 years or so, but it just takes time. And I actually believe that we are getting there ultimately. The challenge is for the small nations is a major one, because many of these systems, they are highly specialized technologically, for instance, satellite systems or missile defense systems, and also the product development cycle is getting shorter and shorter. So the challenge is there, certainly, but I think that's like emphasizes the collaborative efforts there.
Okay, thank you. We have a bit less than 5 minutes remaining till the end of this panel. Maybe we have questions in the audience? Yes, please. Maybe, yeah.
I am former member of the European Parliament and actually was responsible for European Investment Bank and all capital markets on behalf of ALDE Group. My question is, what is actually outstanding debt of European Investment Bank right now? Because as you know, IMF warned European Union that debt level breached secure frontiers. So what is outstanding debt of European Investment Bank now?
You know, our goal every year, the goal is to invest 90 billion euros in the European Union and 10 billion outside. This is our goal every year. And I think we are still now in signing with, I think, nearly 70 million. I look to my team, is this 70 billion euros now already signed?
Okay. Do we have any other question? Looks like no. Then let's dive a bit to the future. Nina, I will start with you. SEB is a very important financial institution for the Baltics. In 5 years' time, do you foresee what share of your corporate portfolio will be allocated for defense or dual-use financing? It's almost a commitment.
I don't actually have a clue at all. I only know that we are extremely well equipped to do these type of financings, and we are currently also active, and we can liaise with NIB and EIB, and we can also do things alone. It is certainly a very growing sector, but I think there are definitely still also some challenges that we need to solve, and then also how much you include under the proper concept. But it is definitely one of the fastest growing segment in the future, I would assume.
Okay, thank you. Now to the rest of the panel. 5 to 10 years from now, this European defense financing ecosystem. Can you tell how you see it? How it will look like? Who wants to start? Just pop.
I think till now we did the right decisions to improve. And we have really an excellent cooperation with the Nordic Investment Bank as well. And we really have to learn a lot. And it's still a learning process. Yeah? So I think it's really hard to say what will be now in the next 5, 10 years. That what I can say is that we are really try to improve in this field, to learn, like you said, because it's really sometimes not easy. What does this really mean at the end, also for the other investment portfolios? So I think it's a learning process. It's absolutely necessary to communicate, to be in a line with the EU Commission, because it makes no sense to double things and which are not efficiently used afterwards. So I think, yeah, what I can say is it will be an ongoing process, and we are going on always to improve. Yeah.
Okay, thank you.
I'm an optimist. I love challenges, and I think the challenging situation we see today makes us stronger. We have smart people in Europe. We have succeeded on innovation before. The Nordic-Baltic region is prime example. If you look at any list of competitiveness, relatively still low level of bureaucracy compared to maybe some of the other European countries, etc. I think we're going to do well. We will figure things out. And it's these difficult situations, I think, that get the best out of us always. We've been in a fairly comfortable situation now for a few decades, certainly in some of the Nordic countries. And I think the Baltics were also kind of gradually joining this club of, look, developed and relatively boring, where you don't need to stretch too much. I think it's now clear that the heyday is over. The cheap Russian energy, the cheap Chinese consumer goods, and the cheap American security is not going to come back. So we're going to be 5 to 10 years from now, we're going to be a lot stronger on our own feet.
Okay, thank you.
Yeah, I think we are on the right track, basically. So I hope that nothing more drastic happens in the 5 years, but can't count on that. But I also hope that the dual use and civil resilience and economic security gets stronger. And that's not a minor request on the innovation side of things.
Okay, thank you. Nina?
Yeah, the world probably will look very, very different, but people are better at doing predictions. Definitely, I would assume that Europe has much more own production and is less reliant on some of the allies as of today. But I truly hope that it will be a free and liberal Europe where also my children can grow up.
Okay, that was a nice wrap up and on a positive note. So, dear panelists, thank you so much. It was really interesting and insightful discussion. So, thank you so much. My pleasure. Thank you.
Thank you, everybody. I'm glad we are back on time and right tight in the schedule, because we do have one final discussion that will, I would say, focus more on the end user, the regular the regular person, if we want to call him that way. Panel number 4, Retail Investment Products Supply Europe versus United States. But first of all, we will listen to a keynote speech. And let me invite on stage Chair of the European Securities and Markets Authority, Verena Ross. Where is she? Oh, she's here. Let's welcome her by giving her a big hand, and then we're all ears. Hello.
Good afternoon, ladies and gentlemen, and Laba Diana, if I pronounce that correctly. Thank you for inviting me here to Vilnius to participate in this important international financial markets conference. I learned earlier this is already the 11th year, and I think it just shows the growing importance of this topic here in Lithuania and in the Baltic region. This conference comes, to my mind, at a very opportune time as we progress on building the European Savings and Investment Union. It is important to acknowledge that past initiatives, such as the Capital Markets Union, have helped to lay already some important foundations. We've made some progress in harmonizing rules, we improved transparency and deepened cooperation amongst supervisors. Yet, despite these achievements, our markets remain highly fragmented. Barriers are hindering companies, particularly SMEs, from finding capital, and it hinders ordinary citizens to basically connect to investing in European growth. This is why the European Commission's Savings and Investment Union strategy represents a logical but also an essential step. It leverages off what has been achieved, recognizes, however, what more needs to be done. And it fuses together by the renewed political momentum, which I think we could also hear here today from some of the political representatives. It recognizes that building an integrated financial system is not only about the plumbing of markets, but about making the system work for citizens and for companies. As we at ESMA emphasized already last year in our position paper, a truly single market for capital requires actions both on the demand side and on the supply side. It is about helping people invest and helping companies to grow. Let me briefly start on the demand side. How to empower European citizens as active investors. Across Europe, households hold more than 14 trillion euros in savings. Yet, most of this remains in bank deposits, earning little or no return. And I understand here in Lithuania, the story is pretty similar. Redirecting even a small fraction of these funds towards productive investment could transform Europe's financial landscape. But to do that, we need to address the barriers that keep retail investors on the sidelines. Limited financial literacy, lack of trust, and insufficient incentives to participate. The Commission's strategy aims to build a more coordinated approach to retail participation. Member states need to play a very active role here, for example, by introducing the savings and investment accounts as outlined recently by the Commission's blueprint, supported by financial incentives to encourage real long-term investment in capital market. At the same time, we need to empower citizens with financial education and with good and usable information. The aim should be to not be to push people into risky investments, but to equip them to make informed choices, to understand risks and reward, and to invest with confidence. Once again, the Commission has brought out a financial education strategy to help coordinate national efforts on financial literacy. Still on the demand side, please also allow me to share with you some further reflections on which I'm sure we will come back to during our panel discussions in a second. In particular, I would like to focus on the role of digitalization in shaping the retail investment landscape and some reflections on whether the investor journey could be improved. In recent years, digitalization has changed the retail investor perspective, how they interact with firms and advisors, and how they obtain and consume information. We've been witnessing a shift from traditional in-person interaction to online investment platforms. Where investors once relied on local bank branches, many now manage their investments entirely virtually. This transition offers clear advantages. It's greater accessibility for newer and smaller investors. It provides broad exposure to the really diverse investment opportunities, and it's much more convenient, as we all know, when we sit on our sofa on Sunday afternoon. The rise of cross-border banks and online brokers, often with lower fees, has further intensified competition, expanding investor choice, and driving innovation across the sector. Periodic data on cross-border investment services show that the number of clients using cross-border services has grown significantly in 2024 compared to 2023. While the phenomenon of rapid growth and user-friendly design of digital platforms offers clear benefits, it also introduces certain risks. And just to mention an example, some entities may deploy design techniques such as dark patterns to encourage constant investor engagement, which might not always align with the best investor interest. Additionally, we have observed that several of these platforms prominently feature particularly complex and high-risk products that might actually not be suitable for the average retail investor. It is clear that while we should aim to harness the innovative potential of new channels and entities to boost retail participation, we should also ensure that they support long-term investing with the appropriate risk-reward profiles and a responsible product offering. When talking of the investor's experience today, one topic deserves specific attention, and that is the role of finfluencers. Increasingly, these are driving many investors' choices. In today's digital age, finfluencers play an important role in decision-making, especially with younger investors. These financial influencers, often active on platforms such as YouTube, TikTok, or Instagram, are redefining how many people access and engage with financial information. With simplified messaging, they are bridging the gap between traditional finance, which is hard to understand, and the everyday investor who would like to understand more what's going on. However, this trend also raises important questions around transparency, accountability, and investor protection. Supervisors have already witnessed cases where finfluencers promote highly risky or even unauthorized investment products and services. As this phenomenon grows, once again, we as regulators and also industry players like you here in the room must consider how to best balance innovation with appropriate safeguards, ensuring that finfluencers act in the best interest of the consumers. In this respect, I welcome the fact that now the co-legislators are discussing some proper safeguards in MiFID II, where firms make use of finfluencers. Let me also use the opportunity to mention that later this month, we at ESMA will publish a fact sheet for finfluencers with tips of how to do their role responsibly in promoting financial products and services. An important related angle of this discussion, especially in today's world, is what we call the investor journey. We believe that the citizen's experience when starting down the investor journey deserves further attention. We as regulators and supervisors should facilitate a more streamlined approach when it comes to the information that investors get and the interactions that they have. This is why we launched a call for evidence in May this year to understand better the challenges faced by retail investors in accessing financial products. The feedback we received confirmed that there's not just one single hurdle or one thing that we can deal with, but that potential barriers to retail participation seem due to multiple different reasons, both regulatory and non-regulatory. We're currently finalizing our analysis and reflection on all the feedback that we received, and we are focusing on how to address key concerns that have come out. For example, how to deal with the information overload that I think all investors currently are dealing with, the complexity of the disclosures, how can we make it simpler and easier to engage and compare, and the advice process. Our goal is to support retail investors to have easier and more effective access to investments and in engaging in capital markets. We also believe consumer testing will have to play a much bigger role in when we design regulation, when we design templates, to make sure that whatever we do brings true benefits to the investor, such as clear and concise disclosures. This initiative also fits neatly with a push for simplification and burden reduction. Let's focus on what is really essential, and let's leave a lot of the small print out when it's not necessary. What is already clear is that us making some regulatory changes in specific sectorial financial regulation alone will probably not be sufficient. We see that there are hurdles for firms to offer investment services and for investors to access such services throughout the European Union. Some of them are due to local tax rules or administrative burdens for investors related to tax filings and reclaim procedures. But also wider topics like trust in the financial sector and the cost related to investing are among the potential hurdles for individual investors. Improving the investor journey will therefore really require a joint effort of all of us, the policymakers, the legislators, the national governments, the supervisors, and the industry. After this short but certainly not exhaustive overview on the demand side, let me now quickly move to the supply side. And this is a side on which we face a different but complementary challenge. Europe's capital markets remain far too shallow compared to the size of our economy. Companies, particularly innovative and high-growth firms, often look abroad, notably to the United States, for scale, liquidity, and investors. If we are serious about building the Savings and Investment Union, we must make our markets more attractive and more dynamic. That means making it easier and more desirable to list on European exchanges, simplifying reporting and disclosures while maintaining appropriate investor protection, and fostering liquidity through well-integrated secondary markets. We should also look at ways to connect pools of capital more effectively through pension funds, insurance investments, and long-term saving vehicles, so that the companies that need the money most can get it. As ESMA, we consistently highlighted this will also require a renewed focus on market infrastructure, ensuring that trading, clearing, and settlement systems are efficient, resilient, and seamlessly connected across borders. These are key parts of our capital markets, and strengthening them will improve market depth and liquidity as well as resilience. While reforms to boost both supply and demand in our capital markets are important, we must also think about the supervisory framework, as was already touched on a couple of times earlier today. A well-functioning market is not just about good policy and regulation. It is also about effective implementation, supervision, and enforcement. We believe that enhancing the supervision of cross-border market infrastructures can play a critical role in improving how markets operate in practice. Market infrastructures, trading venues, CCPs, CSDs, are increasingly pan-European in nature. yet their supervision remains largely national. This mismatch can limit the consistency and the efficiency of oversight, and in some cases hinder the development of a truly integrated market. This is why we believe there is a strong case, also made today by various speakers, for more centralized supervision of certain cross-border pan-European entities to ensure that risks are monitored coherently, that rules are applied consistently, and that investors and companies themselves can rely on a level playing field across the European Union. I certainly look forward to discussing many of those topics in the panel with my fellow panelists, and I want to thank you very much for your attention. Thank you very much.
Thank you very much for your very efficient, smooth, and short presentation. I would like to ask you to take one of the seats, and I would also like to invite on stage Vice Minister of Finance of the Republic of Lithuania, Janusz Kizanevich. I've seen him, I'm not sure where he is now. He is here. Head of International Government and External Affairs at Robinhood, Chloe Bartz. CEO of Revolut Securities Europe, Rolandas Juteika. Fund manager and member of the board at Milvas, Tautvydas Marčiulaitis. He's coming, and have we got one more chair for the moderator? Yes, we do. Ivars Bergmanis, partner at Via Clarus, is with us as well. The light doesn't allow me to see you all, but have a fruitful discussion. The floor is all yours. Welcome on stage.
We'll just try avoiding feedback. I'll get there in a moment. There we go. Perfect. So, distinguished guests, ladies, gentlemen, thank you very much for your participation, and to the organizers for such a great event here today. Now, let's get into the first challenge, and that is called the final panel. In light of the sequence, timing, a little over 1 hour after lunch as well, we have thought of handing out Red Bull drinks, maybe doing stretching, joint exercises, but in the end we decided to utilize an efficient way of covering a very broad topic. So we'll be going into 4 shorter questions, and this way hopefully we'll keep your attention in a more efficient way. So, retail investment product supply, Europe versus USA. Let's commence. So the first topic, what early lessons can be drawn from initiatives like the Capital Markets Union, CMU, and is the SIU, Savings and Investment Union, well positioned to address them? So here I'd like to very much then initially hear the input from Werner Ross and Janusz. So over to both of you.
I feel I've already spoken a lot, so I'll try to keep it short. I think what we can see is that if you look at the European freedoms, which are so important for the European Union and its growth and development, if you look at capital, clearly that is lagging behind. And while we've done, as I said already, a few things under earlier Capital Market Union initiatives and things like that, the reality remains that our markets remain underdeveloped compared certainly to some of the markets in the US, but even within the European Union, you have huge discrepancies in terms of when it comes to capital market development. So there's clearly more we can do, and they remain not only underdeveloped, but, and the two are obviously linked, they remain highly fragmented because you remain with significant barriers across different parts of the European Union. And that, I think, while we've tried to address that step by step, it's clear we need a fundamental scaling up, we need more urgency, and we really need to make a big step change if we want to move ahead. So from that perspective, it's clear we need to tackle some of the structural and political barriers that are there, and we need to make sure that we ultimately connect, as I tried to explain in my speech, the demand and the supply side in a much more efficient way across the European Union. So maybe I just stop there.
Thank you. Janusz.
Yeah, so of course I would agree, and actually what is important to understand that challenges that we have been facing 10, 15 years ago, they remain the same or very similar, but the situation changed, environment changed, clients, investors' needs also changed, and of course financial and non-financial risks evolved. So the question is, can we say that over the years, several key lessons have emerged? And here I would like to point out four questions that what can be and what should be done in my understanding. So first of all, retail investors now need not only access, but they need much more: simplicity, trust, financial literacy. So this is everything what is needed to increase engagement. Second thing is cross-border retail investments. They still remain very limited, and the question is how we can open the doors. What we really need is harmonized disclosures, standardized documentation, digital channels. So again, we have to invest in this. Important question, like elephant in the room, it's how to boost SME financing. But again, SME clients are getting smarter every year. So they need more sophisticated products, they need advisory, they need tailored support, and also simplified pathway to non-bank financing. Last point, but not least, it's EU-level initiatives must be matched by national action. This is something where we have to put more effort on collaboration and coordinate our local, regional, and EU-level efforts, because on each level, because without this, it would be very difficult to achieve the goals.
Perfect. Thank you so much. Let's keep everything moving, I think. Our next topic that we really want to then cover today is called the Atlantic Divide. So that's comparing EU and US market structures and investor access. Here we're talking about comparative analysis of structural, product, regulatory differences between the EU and the US, obviously through time, not just where it is today, and how that has shaped market depth, liquidity, and investor outcomes. So rather than just talking about the US, we actually have someone from the US today. And so I'd like to address this particular question initially to you, Chloe, but also then to Veron and also Rolandas. So please go ahead.
Fantastic. Well, maybe I can start by just highlighting some research from a recent report that Robin had worked on with the World Economic Forum. We conducted a global retail investor survey where we gathered insights on the trends and habits of retail investors across a number of markets around the world. And a striking statistic that we found was, on average, US households held about 30% of assets in equities. And compared to some of the larger European markets, in Germany it was closer to about 9% of household wealth. In France it was closer to about 5%, and in Ireland only about 2%. So I think that habit, that muscle of putting wealth into capital markets to experience compound interest and continue to grow your assets just isn't necessarily as developed here in Europe. So I think some of that is largely due to the investing culture that has existed. In the US, you know, the investing culture was largely driven by tax incentivized retirement accounts such as 401ks and IRAs, whereas in Europe, I think the culture is more largely focused on state-backed pension funds and putting assets in real estate. So in the US markets in the 2000s, I think the investor movement was really sparked by the rise in ETF access, but I think we saw an enormous push towards participating in capital markets in the mid-2000s when platforms such as Robinhood were established. And I think that's because we were able to bring down the cost of investing by eliminating commissions and account minimums. We were able to increase access, and that was by integrating technology into investing platforms to streamline the user interface and to remove jargon to make investing feel more approachable. So in the EU, I think with the movement towards a savings and investment union, we're really heading in the right direction to start creating that investment culture so that people view the stock market as a tool for wealth creation.
Okay, fair enough.
Yes, there are plenty of statistics around when you look at the comparisons between, I have got one here, which is about Euro area households have only 11% of their financial assets in investment funds, less than half the proportion in the US. And similarly, if you look at how much of financial wealth actually sits in not even saving deposits very often, but current accounts, is enormous. But again, I would emphasize this also varies enormously within the European Union. So you have, for example, in Sweden, 12% of the wealth of financial assets is in deposits, similar to the US figures, while in Cyprus it's 54%. So it's really a huge range if you look at that. So there are large differences, and I think a lot of that is driven by national level tax and investment incentives in reality. So it's quite hard to push that from a European perspective. I think it really has to be a coordinated effort between the EU level and the national level to move in the same direction. And in a way, it needs to fit into the local culture, it needs to fit into the local market structure, but it should all push in the same direction. And a similar area where there are huge differences still with the US and also amongst the EU countries is when it comes to cost of investment funds, for example. We published yesterday actually an extensive study that is looking at costs not only at the manufacturer level, but also for the first time at the distribution level. And you see the differences are again enormous. And certainly if you compare it to the US, it's just more expensive in Europe. And that means in the end, less return for the retail investor.
Just between yourselves, before we hear from Roland, a quick question. And I don't know how much you've spent time comparing each region or each other region to your home region. Transparency of these products, you said costs. I mean, people frequently in the EU say that, oh, yeah, really big challenges with the transparency. Is that something you would agree with? Or Chloe, do you have any particular views between each of your home regions or the other region?
Sure. I mean, I think part of the importance of the Savings and Investment Union proposal is that I think we need greater harmonization of exactly these sort of components. So risk labels, fee transparency when consumers are purchasing different assets. I think that will build trust in the system and enable greater participation.
Yeah, I would very much agree with that. I think we already have quite a lot of information being given to the retail investor, but not in a format that actually allows for quick and easy comparisons. And I think that's really what's lacking often, and that is undermining some of the competitive spirits that should drive down some of those excessive costs and should make sure that we actually have a retail investor who is better informed and can actually take informed decisions about where to go.
And doesn't need a PhD in finance, I guess. Perfect. Thanks. Roland?
Many good points were mentioned. Just to add one more maybe on top, we talked about costs. I would say that it's very important, one topic that we didn't mention is financial literacy. To add like why, during the last 10 years, I would say the barriers for European investors to different asset classes almost decreased to zero and are more or less the same as for US investors. What happened? So Robinhood, Revolut, Trade Republic, many other brokers started offering services that were not maybe accessible 10 years ago, free of charge, commission free of charge. So users got access to the securities that were not basically available 10 years ago. So now, if you want to invest, you just take your phone and you can do the trade. Just the thing is that financial literacy is not on the level in Europe where it should be. So if we would spend more efforts to think how to increase that part, that would be a game changer going forward.
And maybe, considering what we've also heard today, it's also not just history of a US capital market being older, but the depth of the European capital markets is certainly shallower, so there's been less time or less opportunity, I guess, for investors to get to know the the details underneath and learn a bit more about capital markets as well. We'll certainly cover financial literacy later on today in the final topic, but that's some great input, so I appreciate that. Okay, Janos, anything else to add, or we can continue? Perfect. And Tobias, all good? Excellent. Okay. One other topic that we did hear bits and pieces about today, and at all costs we want to avoid a copy and paste scenario, is that the Baltic market and smaller EU markets continue to be classified as frontier, emerging frontier, advanced frontier, despite the institutions that they're actually part of, Eurozone, EU, OECD, and NATO. Now, my question then is, maybe there's some additional angles we can consider taking. Baltics are all about innovation, or perhaps even at an EU level. So from one aspect, MSCI benchmarking is the paramount roadmap for institutional investors. However, retail investors do not have this somewhat mandatory requirement for benchmarking, and also represent the largest active weighting of activity on the Baltic or the Baltic region's exchanges. Now, there are many economists here, so I'll also say, on the other hand, are there things we can really do, even at an EU level, to encourage retail investors throughout to visibly see the possibilities of where to invest? So perhaps I'll ask then your thoughts within the panel. And I mean, this is really focused towards Janos, Rolandus, and Tautvidas as being more the sort of markets and let's say policy related people. What are your thoughts on perhaps the perspective of creating something like an EU-based Wilshire 5000, which is the US benchmark, including all listed stocks, because we don't really have that now, with access to investors throughout? And that also then raises the cross-border visibility of smaller companies throughout the EU and the challenges that they're engaging also throughout, mainly perhaps relying on a domestic audience. Because retail investors, at the end of the day, they are also biased by existing index-based summaries, just the top big companies, and not really easily seeing what other possibilities might be there. So, I mean, we can certainly start maybe for this particular question with Janos. Any particular thoughts there? Let's hear it from you, please.
Okay, so in this situation, I think we have at least two options. First of all, complain, do nothing, look around. But first of all, in this region, people do not complain. And in this region, people are hardworking. So I would suggest to choose second option. Second option is to do more solid, new, innovative solutions, initiatives across Baltic states. Why it's important? We already achieved some solid, important milestones where we started integrating our Baltic capital market. And this is a significant achievement. And despite the fact that we still, as a single investment region, we are not able to meet quantitative requirements, but we met qualitative requirements. And with very good examples, like Pan-Baltic Capital Market Memorandum, like joint covered bond framework across Baltic states, like newly established Baltic Capital Market Development Accelerator Fund, MSCI Baltic Index. So we have this. We already achieved solid milestone, but we can't stop. And what I truly believe that by working together with Latvia and Estonia, we will be able to do more to move forward. And then we get back to our partners on European Union level, and we will be able to convince that this is truly value proposition. This is a good example. This is what have been done across Baltic states, and please learn from us. Yes, we are small. Yes, we are compact, but we are fast. We are smart. We are hardworking. That's why we will not stop.
Okay, thank you. Others?
Yeah, I mean, as mentioned a number of times today, if you look at our markets, we meet with qualitative, requirements from most of institutional investments, and it's good that we got this Baltic index, and everything is fine. But the problem is that the money is still not coming in from institutions. Why? Because we are too small. We are too shallow. I've been speaking to lots and lots of European, even not to mention US or UK-based funds and institutions, just European ones. Everyone from Scandis, from Germany, are telling me the same thing. Yeah, market is interesting. I mean, we like the risk premium, we like the quality of the companies, but we will not go there because there's no liquidity. And any initiative to bring liquidity in is very welcome. And as you mentioned, this whole Europe index, for example, which would include 5,000, 10,000, I mean, whatever the number may be, and which would actually, you create this index and you go to Amundis and BlackRocks of this world and tell, look, we have this. Go and make an ETF, make UCITS fund, push it to your investor base and push it to pension funds. Then naturally, via this, whole Euro fund, you get money flowing into local markets because there's no, discrimination. You have weighting on the index and money simply comes in. So you get the liquidity flowing a bit by bit. When you get liquidity flowing, you can, get interest from retail. Because if you look at Baltic equity market, I've been telling that for so many years that, if you buy local equities, you're buying perpetual bonds basically because you buy them for dividend yield. That's it. You do not expect growth. You do not expect too much liquidity. You buy and hold them just to get dividends. And I know that many people agree, and I know that many of you would not like to agree, but that's the reality. So if we get this non-discriminating flow via any kind of instrument and we start moving the liquidity needle, I think that would be great, and that could kickstart further growth and bring institutionals afterwards.
Any initial idea, and I mean, this doesn't have to be binding on you by all means, but who might be best situated to launch or basically help facilitate something like this? Are we talking about the private sector, the public sector, or maybe a joint approach? How do you see this best being, let's say, created?
I think it should be a joint approach. Public sector should go to private sector, like I said, Amundis and BlackRocks of this world, and tell, look guys, let's make this happen, it will be beneficial for everyone. You'll make money on the commission fees, and we'll get more money flowing in from retail investors and pension funds, and et cetera, et cetera. So no, it's a win-win situation for everyone, but I think, that with public backing, it would be easier for private sector to simply come in and do that.
Which might imply index providers, so we need to find the right arguments, I guess, to have them facilitate something like this. Clearly, you've thought about it, and you're willing to be part of this working group, I guess.
Yeah, sure.
Excellent. Rolandus.
Yeah, I would definitely support this idea. One of the reasons why, in Europe, maybe not like people not invest as we expect, as much as we expect, because in United States there is much bigger choice of indexes, ETFs, stocks. So there are much more products there, and they are much cheaper. So the more we have in Europe indexes, the more we'll have ETFs, because ETFs could be based then on those indexes. And it's probably not the case that we just need one, like 5,000 or 10,000 biggest ones, but we could create sub-sectors, sub-ETFs, sub-indexes, because in order to attract attention and to make, as an example, Baltics more visible, probably there could be like more indexes related to Baltics, not just one.
Mm-hmm. And maybe even cross-border for smaller companies. I mean, let's say you're a retail investor in France, Germany, something like that. I think it's still quite challenging to see even what's further elsewhere in the continent. It doesn't matter whether it's in the Nordics or elsewhere. There's no real easy way, I think, of slicing and dicing and understanding how those stocks come through. Yes.
I mean, sorry, you can continue if you want. I'll just jump in after. But no, the thing here is what you also need to understand is that no retail investor from France will buy Baltic index. I mean, okay, you may find one or two, but that's it. So what you need to do is convince them that they're not buying Baltics or not buying Scandis or not buying Nordics, but you're buying the whole damn Europe. You're buying the whole thing. That's what you're getting. Have to sell. It's not like, and to expect that by creating, this Baltic index, why? I mean, you can buy Baltic stocks now. It's not open your Interactive Brokers app or whatever app you use. It's easy to buy Baltic stock. No one is doing that. Why? Because no one knows about the market and we are scared of it. And if you look at Nordics, well, the main investor base in, for example, go around Stockholm, ask who your investors are, ask all the funds. It will be municipal money, it will be state money, it will be pensions money, it will be households money. It's not like, US investors are flocking into Stockholm and investing in their real estate bond and, bonds and etc. It's not happening. So yeah, so we need to be more creative and, and not expect that, by doing some local indices and basically promoting local stocks that will achieve something. No, we need to get money in the other way. The investors should not even know that we're investing somewhere else. It's just, they should buy everything, and in that everything, there should be us. I think that's the only, reasonable approach which is reachable.
Thank you. Ron.
Sorry, if I
Okay, we'll go after Roland.
One comment to add. So it's not the case maybe that it's easy access for everyone to those Baltic stocks. I mean, actually, I would say that it's still quite difficult for a retail European investor to find a stock somewhere in another country. And European users tend to invest into their local stocks because they know the company. Maybe that company has an office in their, in their city, so they know what they do. But if they want, or if they would like to see more stocks across Europe, it's quite difficult because another issue, big issue, is European markets are very fragmented. In order for us as a company, for example, to get access to different stock exchanges, I mean, it's quite hard because every integration is different, and we need to do not one integration like for US stocks, but 10 different or 20 different. And actually, we are being approached by many different stock exchanges with their questions. So how to make our stock exchange being available in Revolut app? And yeah, we say it's quite difficult at the moment because if we do one integration, it's quite complicated for us. If all the markets would be combined, then it would be another story.
And the harsh commercial reality, always having been on that side of the fence as well, is certainly, well, if there's going to be a very small market or small proportion of your business coming from a particular market, can you make the argumentation that, okay, this is going to make sense commercially, whereas, the so-called Pareto principle of, 80-20 or something like that, do we feel not only a moral obligation to connect up these European markets, but that there's actually some sort of commercial sense, because I'm seeing that as being somewhat of a barrier at the moment as well. Chloe.
So I was actually going to make a similar point. So maybe if I could just build upon it a bit further. I certainly think there are remaining friction points for accessing cross-border markets in the EU. So I think one additional tool that we haven't discussed yet is tokenization. Tokenization of assets. I think there are a lot of benefits to putting real-world assets on the blockchain, such as instant settlements, reduced settlement costs, 24-hour markets. So removing some of the barriers of traditional capital markets, I think could encourage greater participation, but I think a more specific benefit to the European market is eliminating some of those friction points for cross-border investing, including tax issues and things like that. So I think that could help to repair the existing fragmented system.
Yeah, just to quickly react, because I think clearly we will see more tokenization of assets that's going to come. There's no question about it, and it has possibilities. But I think it's really important that we tackle the fragmentation that we currently have and the difficulty and the cost of interlinking the different bits of the European market, because it's really only when we bring down those barriers, we will create some of the liquidity that can genuinely flow anywhere in the European Union, and not just to a single stock exchange, to a single clearing system, and to a single settlement system. So I think that is extremely important. And the other point I just wanted to pick up is the importance of pension funds and institutional money as well. If you want to get depth in liquidity, yes, you can do a lot with retail investors. We should encourage more retail investor engagement, but you do also need the institutional money to some degree. And I think having, pension funds that actually are there to support the European economy by investing in our markets is also extremely important.
Looking from slightly different perspective, and I do believe it's important because we focus a lot on size, on access. But for us, for Lithuania, Latvia, and Estonia, it's so important that our champions, our global champions that produce global products, they consider, or they will be considering IPOs in coming months, coming years. So that's why it's crucial to attract, to convince them to do dual listings. This is something what it's not easy, again, due to costs, due to liquidity, and all other questions and challenges. But this is crucial for us, for our market, to grow up. So I do believe that we will move another step into this step forward, because it will be another milestone for Baltic capital market.
Okay, thank you. Anyone else? No? Let's maybe then move to the final topic that we have today, and that is the limitations of financial literacy as a solution. So how retail participation and education need to evolve through time. We had a little bit of that covered during the keynote speech from Verona Ross, but perhaps we can hear from people with very close contact with these sort of investors. So Chloe, certainly, we'd love to hear from you, but then also from Tautvydas and Janusz, and by all means, Rolandus, chime in, please. But ladies first.
Sure, thank you. So Robinhood has 26 million customers on our platform, and about 50% of those customers are first-time investors. So they're accessing financial markets for the first time on our platform. So we recognize that with that increased access, there must be increased education. So that is why Robinhood places an immense importance on offering different methods of financial education. So we have a Robinhood Learn website, which is essentially a glossary of nearly every financial topic you could think of, and providing further information on that for both customers and non-customers alike. But then we also integrate educational moments in our app. So having info labels in our platform. Let's say you hold a stock in your portfolio and it's particularly volatile that day. There will be a warning label that pops up and encourages you to learn more. And we also have resources outside of the app via video or a newsletter in a really digestible way. So I think bringing education to meet people where they are is so important. But another element that we haven't talked about yet is confidence building with consumers. And I think a large element of that is providing sufficient education. But also, from the World Economic Forum study that I referenced earlier, we learned that 42% of global retail investors learn by doing. So continuing to prioritize breaking down barriers to allow retail investors that access to try out investing by purchasing, $5 a fractional share of Apple and taking that first step, I think is the right motivation to usher in more investors.
Thank you. Taulidas?
Yeah, I mean, I really agree that, investing is not learned by reading about it. It's learned by, actually going on and taking on the risk and, losing money at first. That's how you learn. And I mean, in my opinion, if you did not lose any money while investing, you are not a good investor because you do not understand the risk. You do not know how you feel when you get, the risk, when you actually feel the risk. So yeah, so that's my, point of view here. And if somebody comes in and tells me, that he or she has always made money, I think of them as really terrible investors. So yeah, but I'm really happy that, guys like you are coming in here to Europe and, providing access to retail investors to actually go on and buy stocks, and trade. And, sitting so close to you, I'm a bit afraid to say this, but I really hate MiFID II. And I have a friend who worked on it, and after a couple of beers, we always get in this argument where he calls it a big, beautiful bill, and I say, it's not that, definitely not that. Because I've been working on MiFID II. I helped implement it in one of the local banks back in the day. And up till now, I have this PTSD. I'm afraid to say out loudly that Apple is a good company because I'm afraid that Bank of Lithuania will come in barging and will take me to jail for a couple of years just for saying that. So, and then, you get, and I remember when we implemented it in the bank, we decided to basically not stop, but to limit our service on single name stock, research, providing, sales or whatever, single name stocks, because as the regulation intended, we pushed everyone towards this package, basically, funds. So, and I think, between 2016 and now what happened is that most of old school banks got out of business, and I know for a fact, at least in Lithuania, it's you cannot get an advice on single name stock or whatever product. If you go to a bank, even private banking units, what we tell you is buy this fund, just either buy this or get out. But that's it. So and that creates a station where you have so many people in the system who would like to learn, but when we go to credible partner as a bank simply tells them buy the fund, and yeah, sure. I mean, but that's boring. You learn nothing from that. You get no risk basically from that, and then that leads them to influencers, to some random posters on the internet and whatever. And I think so. If I could, do something, I would allow everyone to do anything on the financial markets for the first couple of years with limited amount of money. You can bring in 1,000 euros for the first years, and you can buy whatever you want. Options, swaptions, whatever. Just go for it, learn, and after that you can start actually investing. That would be my approach towards this education of investors.
Thank you. Before we go to Janusz, Rondas, anything you'd like
actually,
to
I can add interesting and important point actually to be mentioned. So when user onboards to the platform where he can trade, I don't think that it is an education. It's user manuals, how to use the platform. It's not an education. Education has to start a lot earlier before user understands where he wants to invest, which platform to use. And I think that's a much more significant question, like maybe to government, to put educational courses into schools. I think education should start in that place where user doesn't even understand that there is such a platform which offers investment products. So it should start like how to use your money, what are those investments, not like what button to press to buy.
Okay, understood. Good point. Thank you. Janusz?
I believe that by working together with the private sector, we are capable to resolve all these existing issues and challenges like lack of financial literacy, not enough trust in financial sector, relatively high fees, We are capable to this. We have resources. But the thing is that we have joined our forces to work together, communicate together, be transparent. This is the thing. We have to invest in transparency. This is important thing. And looking from public sector perspective, we already have a plan. We have public financial education plan. We have capital market development guidelines. So the question is on execution. And public sector would like to do this together with private sector. Then we will achieve another goals.
I mean, also coming from my side, I mean, one thing, we're very much attributing this directly to, okay, financial instruments immediately. I think there's also the psychological side or let's say mental training. And also as a co-founder and chairman of the Latvian Financial Literacy Society, I mean, 2 days ago we launched the Latvian version of The Algebra of Wealth by Scott Galloway, and we could certainly see some very good input from people who had already read it and said, okay, it's not just about, okay, do I buy this stock or that instrument? It's also this whole thing of, focus, obviously, which is the first part of the formula, but then also this stoicism, time, diversification. It's not just really, about the financial instruments. Verona, anything you'd like to add? I mean, I'm super keen on seeing this guidance for finfluencers, but anything else you'd like to add here, please?
I don't think I can stay completely silent when next to me, we are getting rid of MiFID II. I have to say, I think I'm not saying that MiFID II is the most wonderful piece of legislation we've ever designed, and certainly also it is MiFID. That means it's a directive. It's being implemented differently in each member state. And I think it has also led to a growth of additional legal documentation, additional requirements at local level, which have not helped to, it's all hung on this European legislation, but actually in reality, it's a lot more diverse where some of these barriers are coming from. But from my perspective, the principle of MiFID is you should do the best in the interest of your customer, of your investor. And I think that is the core which we need to remember. Then, can we do it in a more simple way? Can we encourage the ability of financial services firms to actually be able to inform and lead and guide their customer? I think, yes, we can rethink that. And one of the things that we are doing with this investor journey, which I just referenced, is exactly that. What are the right disclosures for the retail investor? What does an investor need in terms of support and guidance to actually be helped in the process? And some people don't need and don't want any support and help and actually want to do execution only, and that's also fine. But I think we just need to make sure that we create a way to make it easier for retail investors to engage in the capital market and start early with the financial education. I would very much support what others have said. It has to start in the school age. It has to start at difficult periods in your life when you have to take financial decisions.
Excellent conclusion. I think time flies when you're having fun. I think we've pretty much run out of time. Everyone, I'm sure, is super keen to get networking moving. So first and foremost, fantastic panel discussion. Thank you so much, panel members. Thank you for being a supportive audience and not walking out too much. And I wish everyone a great time now for your networking. Have a great afternoon. Thank you.
Thank you very much, everybody. Thank you for this last engaging panel. I will take just a couple of minutes to do a little summary in case you've missed any of the panels, some key takeaways. Please don't be mad if you have taken some other takeaways with you. So we have said in the beginning that security, the commissioner said that security is not just defense, budget, and military. It's also economic power, investment, innovation, and the attraction of capital. Europe does have a dual task to protect people and at the same time to create a financial infrastructure that allows us to be globally competitive, because this is too a strategic security instrument. The success of the Baltic financing ecosystem was emphasized. Living next to Russia's aggression and constant threats, we are able to maintain resilience, moral clarity, and solidarity. And yes, the Baltic solutions are already, some of them are a model for Europe: joint financial products for investors, integrated market infrastructure, regional visibility in global indexes, an active startup and venture capital ecosystem. And as the Commissioner said, when we move forward together, we can achieve a lot. For example, single market was once an ambition and is now a foundation. During the first panel, we discussed savings and investment union. We have said that productivity gap is a big issue. There was a need expressed to regulate for growth, not just for risk. European Commission agrees that better balance is needed here. Too much regulation, too many thousands of pages, while not enough regulation on crypto is risky, according to some. Stronger investment culture needed, a strong pension system across the EU. Please handle it in the right way, as the Swedbank representative has asked. Create environment for investable business that will survive consolidation, but don't leave small markets behind, to which European Commission says smaller markets. It has to be a joint effort. We need to be bold and disruptive. Fear of change still prevails. Silicon Valley of smaller scale happening in Lithuania currently, some examples presented. In terms of capital markets, we need to get to single supervision, which is not the same as single supervisor, Commission says. Then we got recommendations, very specific ones for developing Baltic capital markets. And there was an encouragement also, besides those recommendations, to be a role model of where to go with a savings and investments union. Rebuilding Baltic capital market is like rebuilding a house, someone said. The role of public sector is to catalyze the process here. Backstops are crucial. A simple, straight list of priorities is needed. Next, it's also not just about institutional investors, it's about local retail investors. Two easy and understandable instruments to enter the capital market are needed. That was also mentioned in the previous panel, not just in this one. A bond in the capital market as an idea, for example, that would also help increase financial literacy about the capital markets, Lithuanian Central Bank said. And a single pension product approved by all Baltic countries was another idea presented by some of the speakers. Then we got the EIB listing 5 financing priorities related to defense, protecting critical infrastructure, boosting industrial capacity in critical areas, R&D, cutting-edge research into startups, scale-up, supporting private investment funds. And we have said that defense financing is a new normal. There are challenges related for financial institutions, so we discussed them. We discussed the need to make maximum impact on defense procurement in the EU. Common Nordic procurement actions are already taking place. More cooperation examples were introduced of international financing institutions with local ones. The pressure is rising for the EIB to finance ammunition, for example. We have many financial instruments, we just need more knowledge about them. Civic side of defense should not be underestimated either. Comprehensive security is becoming an export product, as the Finnish minister said. Short-term needs and long-term development. There is plenty of money in the world, it's just a matter of attracting it. Let's invest in the money in defense efficiently, that it should also generate growth. We need more incentives for more member states to collaborate. Dual use will get stronger in the nearest future. Last but not least, the ESMA presentation, the last one, have emphasized that we should not push people into risky investments. We need to equip people to make informed choices and invest with confidence. Financial education strategy was mentioned. While we aim to boost retail participation, we should also make sure it's long-term. Influencers were mentioned. They are redefining how people engage with information, and there was a need expressed and some instruments to ensure they act in favor of everybody, of retail investors. How to deal with information overload was mentioned as an issue. Consumer testing, that will have to play a bigger role in the future. And then supply side, Europe's capital markets too shallow. Companies look abroad for scale, liquidity, and investors. Connecting pools of capital more effectively are much needed. Enhancing supervision cross-border may improve efficiency. Cross-border supervision for certain entities needed. And as for the panel that you've just heard, let me single out 2 points. One of them was 42% of retail investors learn by doing. So if you haven't done that by now, just do it. There was another one. You have just heard everything. I will just say that someone, I think the Vice Minister for Finance, said that we are smart and fast and forward-looking in the Baltic states. So I will just thank you very much for coming here, sharing your ideas and insights. Good luck with everything, and I really hope to see you at the 12th International Financial Markets Conference next year. Thank you so much, and have a good networking, which is happening right now.